I'm Eric Toder of the Tax Policy Center. Thank you for joining us for the 11th Annual IRS TPC Joint Research Conference on Tax Administration. This year's event is especially timely, given growing interest in the need to adequately fund the IRS, concerns about the tax gap, and increased discussion of how to fix it. We have, as usual, a great list of speakers and discussants for today, with sessions on individual tax compliance, new developments in technology applied to tax compliance, the tax compliance process, and taxpayer service. We are also delighted to welcome Commissioner Charles Reddick as our introductory speaker, and our former colleague, Acting Treasury Assistant Secretary for Tax Policy, Mark Mazur, as our lunch hour speaker. Before we begin, a few housekeeping items. Today's event is being recorded, and the recording will be posted online soon afterwards. For those joining by phone, the slides are all available at taxpolicycenter.org. All participants are muted. Please type your questions and comments into the Q&A box at any time during the sessions. We will get to them during the Q&A period at the end of each session. Be sure to include your name and organization. We also encourage you to join the conversation online at Twitter with the hashtag #LiveAtUrban. I would now like to introduce Barry Johnson, who will introduce Commissioner Reddick. Barry is the Acting Chief Analytics Officer of the IRS Research, Applied Analytics, and Statistics Division. Hope I got that right. In his leadership roles over the years at the IRS Statistics of Income Division, Barry has provided key support to tax researchers both inside and outside of the federal government, and we at TPC greatly appreciate his contributions. So over to you, Barry.
Well, good morning, and thank you. Welcome to this 11th Annual IRS Tax Policy Center Joint Conference on Tax Administration. Thanks very much to Eric Toder and the Tax Policy Center for hosting this virtual conference, and thanks also to the conference organizers for the difficult work of putting together today's program. And finally, perhaps most important, thanks to our speakers for their excellent work and for taking time to share it with us today. This conference provides an important forum for sharing ideas and insights that will directly contribute to improving the administration of our tax system. Thank you for helping us build toward a new era in tax administration. And then now, without further ado, it's my great honor to introduce Charles P. Reddick, the 49th Commissioner of the Internal Revenue Service. As Commissioner, Mr. Reddick provides over the nation's tax system, managing an agency of about 80,000 employees and a budget of more than $11 billion. Prior to joining the IRS, our Commissioner was with the law firm of Hochman, Salkin, Reddick, Tosher, and Perez, PC for more than 36 years. In his practice, he represented thousands of individuals, businesses, and corporate taxpayers before the IRS, the Department of Justice Tax Division, federal and state courts, and state taxing authorities. Commissioner Reddick has held leadership roles in a number of professional organizations, most recently serving as the Vice Chair for Administration for the American Bar Association's Section on Taxation and President of the American College of Tax Counsel. He was a member of the IRS Advisory Council for 3 years, beginning in 2008, and served as a chair from 2010 to 11. He also served as the chair of the taxation section of the State Bar of California and has served on the advisory boards of both the Franchise Tax Board and the Board of Equalization in his home state of California. Commissioner Reddick has received numerous professional honors during his career from organizations across the country. He's been a featured speaker and panelist at hundreds of tax conferences throughout the US, Europe, and Central America, and has authored numerous tax-related articles. He received a BA in economics from the University of California at Los Angeles, as well as a JD with honors from Pepperdine University and an LLM in taxation from New York University. Welcome, Commissioner Reddick.
Thank you very much, Barry, and thank you, Eric, and certainly a Tax Policy Conference for including me and for including all the IRS folks who are going to be speaking throughout the course of the conference. Research is important to the Internal Revenue Service and important to the country throughout the history of the Internal Revenue Service, but it's more important if you look at what we're facing today in terms of the IRS struggling with respect to resources, the allocation of resources, and the efforts that all of you have and the topics that you have today are critical for us in terms of planning for both the near and the long term. And then similarly, I'm sure most of you are aware of the president's budget proposals and the interactions up on the Hill with Congress, which are highly focused on where certain dollars can go from a budget perspective to assist tax administration. Since I've come on board, I've stayed with one theme. And as Barry said, I was 36 years in tax practice on the outside, did my best to help tax administration in the country, came on board, and my theme has been continually that tax administration does not belong to anyone. It is not the sole responsibility of anyone or any particular agency, but that I've always considered it a privilege to try to help improve tax administration for the country, and especially for the underserved communities and individuals who don't otherwise have a voice in what, where, how the Internal Revenue Service should be doing things, what, when, where, how Congress and Treasury should be looking at tax policy. And it's important. And one of the important focuses is the information we get from research. And, you know, the IRS is focused highly on the tax gap, but we're focused on a lot of other areas. If we move in a certain area, what's the impact, both from a taxpayer burden perspective, as well as from a tax administration, or if you will, tax compliance perspective. And those two go hand in hand. And, you know, we really spend a lot of effort on the, what we refer to as the service side of the house. Tremendous number of people, you know, give their best efforts to comply. I'm very proud of the Internal Revenue Service. The course of the last year, since I've come on board, the efforts that we've done with respect to underserved communities, the supporting of low-income taxpayer clinics, tax counseling for the elderly, the VITA programs, and especially a huge launch last year into serving people who are less comfortable operating in the English language. And I think most of you are aware, the IRS went into the Form 1040 for the first time in history, is both in English and Spanish. People can call into our phone services and get translation services in up to 350 different languages. They can check a box on a Schedule LEP and indicate what language they want us to interact with. All of that is, you know, the data behind all that is critically important to not only which languages we go to. I think that wasn't a big challenge. You can figure it out. If you live in the country, you can figure out probably the top 20 or 50 languages that we should initially go into. But what we should do in those languages, where we should go, where we should focus services, very important. And similarly, where we should focus what we call taxpayer assistance centers. We don't have the ability and the funding to staff all of our taxpayer assistance centers. So, you know, Raz and Barry and others and outsiders as well, doing the research, help us focus on where we can be most impactful. Although we're not a private sector entity, so we're a service entity, so we don't look at dollars and cents, but we do look at, if we have one person that we can put somewhere, where can that person do the most good? And, you know, without research, without people sort of helping us guide that, I think it's pretty easy to say that we would make a lot of moves that would not be the most beneficial that they could be. So hugely proud of Tax Policy Center, proud of our RAS department, extremely proud of Barry. He's guided us in a lot of directions since he's been serving as the acting, and we wouldn't be who we are without all of you. And who we are is, if you look at the statistics for the Internal Revenue Service, our gross revenue is about $3.5 trillion a year, which is about 96% of the gross revenue of the United States. And we touch more Americans than any other entity, public or private, and we try to do our best. The pandemic was not only for all of you, but for us as well. It was a challenge. We shut down the Internal Revenue Service in March of 2020, as did most private sector organizations. And we had to essentially figure out how to come back and accomplish our mission to the best of our abilities. We flipped the agency into a virtual environment. It was not seamless, and it was not without a lot of effort. And similarly, there were certain areas that I think we could have done better looking in retrospect. But, you know, the fact that I say that, I think people should appreciate that we tried. We tried really hard, continuing to try really hard to dig out of some impacts that we've had from the pandemic. And, you know, I've continually said, I made mistakes on the outside, I've made mistakes on the inside, but I think the majority of those mistakes have been because we do swing for the fences. We're trying our best to accomplish the best that we can within the limited resources that were provided. We have obviously staffing issues, as well as resource issues, as well as modernization issues. We've gone wholesale into trying to modernize our systems as a first step toward the future, but funding has been a challenge. The president's budget proposals, it'd just be incredible. It would be historic for the Internal Revenue Service, but more importantly, historic for the country, moving us in directions and the ability to actually provide the level, nature, and quality of services that every American deserves. Going down that road, the topics that you have today, I'm very impressed with the selection of the topics. And I would like to encourage you to stay engaged. Those of you who are outside and also the TPC, stay engaged with us. Help us help others. We're here to do our best, but it's not in isolation. So as I said, tax administration does not belong to anyone. It's not the sole responsibility of the Internal Revenue Service. It's not the sole responsibility of employees at the Internal Revenue Service. I like to think of it really as a privilege. It's a privilege for the Internal Revenue Service to be in the role of providing meaningful services, meaningful compliance efforts on behalf of every American. But it's also a privilege, I think, for those of you on the outside, if you're, excuse me, if you're in the research lane, to help us figure out where and how we should do things. And for the people on the street, help us connect with the folks who are otherwise not able to get their voice to us. Very proud of the efforts of IRS and Treasury with respect to delivering 3 rounds of economic impact payments during the pandemic. We've delivered over 474 million payments, totaling more than $800 billion. At the same time, delivered refunds to individuals of more than $600 million for filing season 20, filing season 21, $1.4 trillion out to people during a pandemic. And it's beyond the economics of $600 or $1,400, which are obviously significant and more so during a pandemic. But it also conveyed a message, an emotional message to people that their country is aware of the situation they're in, and their country is here for them and trying the best that we can during a pandemic. And so for the IRS to be part of that delivery, both of the economic benefit, but also the emotional component of we're aware of the situation folks are in, clearly a privilege for our agency, a privilege for me working at the Internal Revenue Service, and a privilege for our employees. And I can't say enough about the spectacular nature of our employees through the pandemic. We've received some criticisms because we didn't get an economic impact payment to everyone, but we did deliver 474 million economic impact payments from an agency that I shut down in March, sent home 83,000 people at 511 facilities, and brought back. There are people who are not in our systems, not in Treasury systems, not in the systems for the VA or the SSA. A huge effort to outreach for folks who are out there. We coordinated with more than 11,000 different community organizations around the United States. More than 400 different homeless shelters served as trusted partners with us, allowing us to distribute payments, checks to folks who are not otherwise connected with a shelter, the unsheltered homeless, if you will. And the reason I go into that detail is we're here again. We have the privilege of implementing the advanced child tax credit payments, which will start July 15. The folks of the Internal Revenue Service, our IT department, have been working around the clock. And, if you follow sort of where I've come so far, the 3 rounds of EIPs, 2 filing seasons, excuse me, and then now delivery of the advanced child tax credit payments. It's quick to recognize that, and I'm only half facetious when I say our IT departments have not slept since March of 2020. We have asked a lot of our people, and that's not to say that people on the outside haven't been doing their share and trying to get through the pandemic and carry on their own missions. But we've asked, I think, much more of our people than the private sector would have asked of people on the outside. And I know, I care a lot about our people, but I'll also say I've never hesitated to say, we need this figured out. I mean, Barry can speak for Barry, but the number of times I've said to Barry, well, what happens if we do this? How much benefit can we provide and how quickly can we provide it? And he's a significant component of the team at the IRS that has really dug in and done our best. And I will be forever grateful to the folks inside the IRS, as well as the people on the outside who've helped us during the course of the pandemic get to where we are. And again, I'm not saying that it has been perfect and seamless, but I think that history will be very polite to the IRS and Treasury when they look at what was accomplished given the situation that we're in. A lot of us have sort of forgotten the concerns that we might have had in March, April, or May of 2020, as the masks are disappearing and vaccinations occurred and whatnot. But if you put your mindset and go back to what the country was struggling with, what individuals were struggling with, what families and neighbors were struggling with, and bring us forward, again, I think history will be polite. We need your help. Outside of the research lane, we need your help with respect to the advanced child tax credit payments, getting the information distributed everywhere, neighbors, communities, if you belong to organizations, social community organizations and whatnot. We have a lot of information on the ACTC on irs.gov. I would encourage people to look and encourage others to look. And, the best I can say is help us help others. We're trying. And these endeavors, the EIPs and the ACTC, if you will, are out of the normal lane of IRS activity and maybe out of the normal lane, which you might consider in terms of tax administration. But I think when you come back to the privilege of being in a position where we can impact others in a positive manner, I think it's easy for people to get on board and to help us help others. So, coming back to the research angle of what we have, from a budget perspective, we are looking to build a new IRS for the future that will be able to accomplish what people in this country deserve and what we hope the IRS can do. The desire of the employees of the Internal Revenue Service to do their best is extremely strong. I believe we will get resources. I believe we'll get meaningful resources across all lanes. So I think we'll be able to modernize our systems. I think we'll be able to onboard significant staff. We'll be able to train our people, and we'll be able to provide our people with the resources to do the best that they can do. Where you all become really important is, beyond the conference today, I would, request again that you remain engaged, that either through the tax policy conference directly or reaching out to myself or others at the Internal Revenue Service with thoughts based on, your experience and the things you've researched. Help us get there. We should not be spending, precious resources and limited resources in areas where we should not be spending them, and we should move those resources to areas where we can be most impactful. And we are the agency, coming back, to beginning, we are the agency that literally touches just about every American. Our challenge is that we need to interact in person. Oftentimes, a lot of rural communities and whatnot, we need to interact on the phone, and we also need to interact online. And we interact with, if you will, the most unsophisticated individuals in the country, as well as the most sophisticated individuals and corporations in the country. And we want to provide meaningful services to all. And obviously those services are different in different lanes of where we're trying to interact. But we do have a very strong line of sight and focus on, if you will, the historically underserved communities, the lower income communities, the communities that may be preyed upon by people based on a lack of sophistication within those communities, or based on the fact that maybe IRS has not historically had a strong presence in certain communities. So the additional resources, I think, will help considerably, but we can't just bring people on board and provide them some basic training and send them out without knowing from you all where and how we should be doing that. That's where the research really becomes important. We need to have your assistance to help us be innovative and creative in going forward, and a look into the future. The future IRS, many of you are aware of the Taxpayer First Act, which we now refer to the future of the IRS as Irs Next Initiative, which is redesigning both our structure and our operating model. We're significantly down the road in that arena, and very proud of where we're headed, and more than willing to have discussions with y'all in terms of that. So in closing, thank you for, I apologize for speaking fast, but I'm trying to cover a lot of ground in a limited period of time and not abuse my your good nature in having me participate. But in closing, let me just stay with the theme of, your efforts, the research you're doing, the research that you coordinate with us, with Raz, with Barry, is critical to the future of the IRS, which if you come back to 96% of the gross revenue of the country flows through the IRS, it's critical to the success of our country, which, in significant part, I think, does depend upon the success of the Internal Revenue Service. And we're quite thankful that I think folks on the outside, and specifically the Hill and certainly the administration, are aware of that and doing all they can to help us be the best that we can be. We're proud of who we are. We want you to be proud of us. We want people on the street to be proud of us. And we want people to, we have to earn their trust and respect, and we need to do the best that we can. So I'm really pleased. I've gone through the agenda, and some of the topics really critical where we have done resources. We put some effort into areas. The passport certification program is critical for us in certain arenas because there are certain taxpayers, if you will, who simply won't pay. We have sort of a can't pay and the won't pay. In that arena, the average taxpayer, my recollection is, and these are not specifics, but is that the average taxpayer where the certification process comes into play, that the assessment is about 6 years old and the liability exceeds about $200,000. Those in some sense might be a less sympathetic taxpayer than the folks that most of us think of as somebody filed a return and can't pay, or they're a year late on their return. Another topic, EITC Non-Compliance, critical area for the country, critical area for people. A lot of issues in the complexity of the EITC statute and trying to administer that statute and trying to do so effectively. We spent a lot of effort trying to get those funds out to the people who are eligible. It's a huge program that's really helps real people in need of funds. The statutory construction, to me, is an area that needs to be focused on. And I realize that's out of your lane, but we've sort of been knocking on the doors, if you will, to have people look at the statutory construction there. Customer experience for small business taxpayers. I come from a small business. My dad had a truck and 2 sons. And, that truck and those 2 sons were critical to, the meals on the table, if you will, every night. I think in a significant degree, small businesses are definitely the backbone of this country. And it brings a lot of people into a world that's beneficial to them, and it allows a lot of self-confidence and whatnot. Pandemic has been very detrimental to small businesses. If you put it in the context of a restaurant or something, you see the same thing I see, which is a lot of empty storefronts, and helping us help small business taxpayers in any way that we can, really critical. And so on all of these areas, I would encourage you to continue the research beyond today, beyond the conference, help us see what works and maybe what doesn't work, and what doesn't work, help us sort of maybe tweak it a little bit so that we can do better. We want to do better. And, you have my commitment to assist where and whenever possible. And, Eric, as far as the TPC, anything we can do to help you all coordinate the efforts that you're doing, your interactions with us have been significant, huge, and critical, not only to the present agency, but the agency that we are looking for going forward. So in closing, thank you again for including me for a quick opening. Thank you for the opportunity to be here. And certainly thank you for the opportunity to work with you all going forward. And with that, I wish you all a great conference. Thank you.
Thank you. And I want to welcome everyone to our first session, Improving Individual Taxpayer Compliance. I'm Robert McClelland, and I'm a senior fellow at the Urban-Brookings Tax Policy Center. Our first presenter this morning is Kyle Furlong. Kyle is a senior computational social scientist at the MITRE Corporation. He'll be presenting Audit Contagion, Investigating the General Indirect Effects of Audits through Tax Preparer Networks. Our second presenter is Paul Organ. Paul is a PhD candidate in economics and business at the University of Michigan. He'll be presenting Do Collateral Sanctions Work? Evidence from the IRS's passport certification and revocation process. Our third presenter is Alexander Yuskavage. Alex is an economist at the Office of Tax Analysis in the Department of the Treasury. He'll be presenting Eitc Non-Compliance, examining the roles and the dynamics of Eitc claims and paid preparer use. Our discussant for this session is Tatiana Homanoff, who is an assistant professor of economics and public policy at New York University. As a reminder, if audience members have questions, please enter them into the Q&A box. I'll present questions to the speakers near the end of the session after they have had a chance to respond to the discussant's comments. And with that, I'd like to turn it over to our first presenter, Kyle.
So give me 1 second to get Zoom to cooperate. Thank you for that great introduction. As Rob mentioned, my name is Kyle Furlong, and I'll be discussing audit contagion, investigating the general indirect effect of audits through tax preparer networks. Before I go any further, I of course have to thank my co-authors on this paper, Ellen Badgley, Lucia Leike, and Lee Nicol, all from the MITRE Corporation, and Alan Plumley from the IRS. So when we think about tax enforcement, we can categorize the effects of this enforcement activity into two big buckets: the direct effect of tax enforcement, which can be thought of as the additional tax that gets collected as a part of the audit, and the indirect effect. And the indirect effect actually breaks down into two smaller subcomponents: the specific indirect effect, which you can think of it largely as the lasting effect of the audit. So to someone who is audited, does their compliance or their filing behavior kind of persist over like a longer period of time after the audit? And the general indirect effect of an audit. And the general indirect effect is interesting because we're not looking at individuals who are themselves the subject of tax enforcement activities, but rather those who are around that individual who is the subject of this audit or this tax enforcement. So these are taxpayers who are connected via some sort of common bond, some network, some mechanism, and through that mechanism, this general indirect effect of the audit is spread. So specifically in our context of this paper, we are looking at this question: can we demonstrate from operational audit data that tax preparer networks facilitate a general indirect effect? So by that, I mean, if an audited taxpayer is using a preparer, and this tax preparer is also has many other clients who are non-audited, does the audit from the taxpayer kind of spread and disseminate through the tax preparer into these non-audited taxpayers? Do we see some sort of change in their behavior? So there is actually some motivation, some background to this. Recently, the general indirect effect, this effect, has been observed as spreading between firms that share a tax preparer when one firm is visited by a revenue officer. Moreover, there's a lot of literature on the effect and influence that tax preparers can influence and exert over their individual taxpayers' reporting towards compliance in some cases, but also towards non-compliance in tax gray areas. However, in spite of all of this research, we still do not know if the general indirect effect spreads and propagates at the individual level between taxpayers who share a preparer. And something that we also don't know that might also complicate whether we can do this and estimate this is we don't know how these taxpayer-preparer relationships change over time. And understanding this might be really important, which leads us nicely into our research questions. Our first being this issue of dynamics. To what extent do taxpayers remain with their tax preparers over time? So to look into these dynamics, we're going to study these taxpayer-preparer relationships over our study period, which is a 7-year time window. And in answering this question, we hope to hopefully take away some insights that we can use in answering this next question. That is, do taxpayers in audited preparer networks differ in their total tax reporting over time compared to taxpayers in non-audited preparer networks? So more simply stated, is there a general indirect effect among taxpayers in preparer networks? So our sample in this study consists of the following. We pulled tax preparer data who had Schedule C, who had and did not have Schedule C correspondence audits in their network. We selected this particular type of audit because in working with subject matter experts and others at the IRS, We understand the operational context of this particular type of audit. And in understanding the context of this audit and how eligibility arises, we can better tailor resource allocation strategies and policy at the IRS if there is indeed a general indirect effect. Throughout this presentation, I'll be referring to the notion of a baseline year as the tax year that a taxpayer entered our sample due to being eligible for this particular type of audit. So let's actually look at our treatment and control groups. So they largely look the same with taxpayers using a common preparer. However, the only difference between these two groups is that our treatment group has an audited taxpayer in their network. Of these two groups, we actually only include the audit eligible taxpayers in our sample. So just to highlight this as it is a slight deviation from a lot of other econometric studies, we are looking at audit eligible but unaudited taxpayers in both the treatment and control groups. So how does this mechanism, how do we, I guess, hypothesize this works? So consider for an example, a tax preparer that has two clients. Both are audit eligible in tax year 2008. However, one of who ends up actually getting audited in the future. Our analysis has shown that there's actually a period of time of, on average, 2 to 3 years after filing before the exam actually opens. So our audited client doesn't even become aware that their exam or their return is under audit until roughly 2010 in this example. At which point we assume in our study that they communicate knowledge of their audit status and of them being under audit to their tax preparer from 2008. And at that point, we also assume that then this tax preparer holds this knowledge and then uses it in helping their other clients in filing. And by helping these other clients in filing, they in turn change their reporting behavior. However, this raises a really interesting issue and really highlights and underscores the importance of understanding to what extent these networks and tax preparer networks remain constant over time. Is there much flux? And to answer that particular question, we actually turn to data visualization. In particular, we use a visualization known as Sankey diagrams to observe and analyze how taxpayers use and move away from their baseline year tax preparer over our study period. To do so, we actually categorize each taxpayer into the following discrete groups: taxpayers that use their baseline preparer, taxpayers that don't use any preparer, taxpayers that use a new preparer, and taxpayers that return to a prior preparer that we have some history in our operational data that they've used in the past, but someone who's not their baseline year preparer. So in categorizing our taxpayers in these 4 groups and comparing how these groups change over time between our treatment and control groups, we hope to potentially identify some behavioral differences between these groups that we theorize might actually affect the propagation of this indirect effect. So without further ado, here is the Sankey diagram showing taxpayers in our control group. So these diagrams can be a little challenging to decipher if you've never seen them before. I will quickly kind of walk through how to understand it and read through it. So across the horizontal axis, we have time spanning from 2 years before our baseline tax year. So when our taxpayers enter the sample due to being audit eligible for the Schedule C correspondence audit, and then spanning 7 years after this baseline year. To go in a bit more detail, let's walk and give some examples. So by definition, in our baseline year, 100% of our taxpayers are in the control group and they're using their baseline year prepare in this baseline year. This is good. This confirms our sample was accurately pulled. However, right away, we actually see something really interesting, I think. And that is in the year immediately following the baseline year, we see only 70% of our control group taxpayers are still with their baseline year prepare, which leaves the remaining 30% go to someone else or somewhere else. So of the 30%, about 25% of them actually choose to file with a new preparer entirely, with relatively small numbers using a prior preparer or filing without a preparer entirely. So when we actually compare the control group, the prior diagram, with this treatment group, the trends we see are largely similar. However, if we actually dig down into the numbers and the flows of taxpayers in how they're using and who they're using for their preparers, we do observe a slight deviation in this trend. Notably, taxpayers in our treatment group are slightly less likely to use their baseline year preparer over our study period. So pulling out some key insights, we note that understandably, in every year after the baseline, there is a steady decrease of taxpayers using their baseline year preparer. However, these relationships are somewhat sticky. And by that, I mean, if someone is using their baseline year preparer 2 to 3 years out after the baseline, they're much more likely to continue using their baseline year preparer as opposed to leaving and finding someone new. Moreover, we found this really interesting group of taxpayers that roughly 25% of our sample seem to employ a new tax preparer every single year. This has some strong modeling implications in that we might not expect this general indirect effect that we're interested in to actually propagate among these taxpayers, since they're constantly moving around between preparers. And finally, as I noted, taxpayers in our treatment group are slightly less likely to remain with their baseline year tax preparer, relatively 5% fewer relative to the control group. So we think that these dynamics have some real world implications that we need to take into account when we're modeling. And because of that, and to do so, we actually turn to a linear mixed effects model using total tax as our dependent variable of interest. We've selected this particular variable as it most closely represents the return on investment that the IRS would reap if indeed there was a general indirect effect present as a result of this particular type of audit. Our primary variable of interest is the interaction between treatment status and time as in the year after the baseline year. Instead of a numeric variable, we do fit this year after the baseline variable as a categorical variable to allow for nonlinear slopes from year to year. And of course, we control for a variety of time effects, as well as we control for reporting characteristics of the taxpayers, as well as characteristics of the tax preparer networks in which these taxpayers are filing. So with that model fresh in our minds, let's turn to some early results. So here on this plot on the right, we've graphed and plotted the estimated percent change in total tax using that interaction between treatment status year and treatment year, exclusively those variables. So right off the bat, we see a stark difference in total tax reporting in the baseline year when we look at our control network taxpayers in blue compared to our treatment network taxpayers in red. We do see that not only are there some large differences with our treatment network being roughly 30% under the control networks, but their trajectory is also different over time. Notably, our control networks largely are flat, although they slightly decrease over the study period, but our treatment network shows this sharp increase in total tax reporting over time, which, if we think about it, this is a sharp increase in total tax reporting after the baseline year would technically be what we're expecting to see if a general indirect effect is present, a strong positive slope as individuals are indirectly exposed to this audit via their tax preparer. However, there's clearly something going on in this baseline year, because we're seeing that these two groups are quite different, even though we've essentially controlled for things that we should be controlling for. But we know that we're not controlling for something because the model I presented earlier does not capture the behavioral dynamics from our Sankey diagrams. So with this in mind, let's use what we know to build a better model, because we know that there is actually a time delay of roughly 2 to 3 years after the filing year before the audit starts and before audit notification. So we would not expect to see a general indirect effect to propagate prior to audit notification. Moreover, we've observed in our Sankey diagrams that roughly 40 to 50% of taxpayers don't even remain with their baseline year preparer over in 2 years after the audit, after filing. So we would not expect these individuals to exhibit any sort of change in their filing behavior. So let's use this information to improve our models and our estimation. To do so, we redefined our treatment variable to be, instead of a 0-1 indicator of treatment status, to be instead the number of years that a treated taxpayer was remained with their baseline year of prepare. It's just a count at this point. So rerunning the same model as before, however, under this new treatment specification, we can see this following result of this panel plot on the right. So in the top left quadrant, we see treated taxpayers who are only with their tax preparer, baseline year preparer, for 1 year, so just the baseline year. This spans all the way across the top row, going to the second row, and then all the way for these 8-year treatment group taxpayers who are with their treatment year tax preparer for the entirety of our study period. So looking at these 8 groups, we still see some large differences between our baseline year, in the baseline year between our treatment and control groups. However, interestingly, controlling for the duration of this relationship between preparer and client does yield some starkly different estimates. And finally, as I hinted at earlier, this positive slope that we're seeing in some of the earlier graphs, in those with shorter taxpayer-preparer relationships, it slowly levels out over time. You could say it flattens, which might actually suggest perhaps a counterintuitive finding, in that there is a smaller general indirect effect among taxpayers with longer preparer relationships, which I'll talk a bit more in our discussion now. So to highlight some of our key findings, we found that roughly 30% of our Schedule C audit eligible taxpayers are actually only with their baseline year preparer for 1 year. Moreover, as I was mentioning earlier, our findings are suggestive of a general indirect effect. However, they're counterintuitive. Entering into this study, we assumed that taxpayers with longer tax preparer relationships might be more susceptible to listening to this tax preparer that they've had a longer relationship with. And therefore, the general indirect effect might actually be stronger in this population. And that's not what we're seeing empirically. However, the continued differences that we're observing in the baseline year, these differences between treatment and control groups, they raise questions surrounding preparer selection bias. And by that, I mean this chicken or the egg problem. Are taxpayers who are in higher audit likelihood situations, are they seeking out preparers that are better equipped to meet their specific tax situation? Or is the opposite true? Are tax preparers actually encouraging higher, potentially riskier business expense reporting, which is then in turn leading to some differences in audit incidents between these two networks that we're looking at? We're not currently sure. It is still under investigation. There are of course, other limitations to our paper. We've used audit eligibility criteria as one of our controls in our experiments and in our models. However, these criteria and rules may have shifted over time. Moreover, a key limitation is our assumption that the audited taxpayer notifies their baseline year prepared. So we actually think that there are some incentives for taxpayers to do this, perhaps in the form of audit protection for past clients. However, we've seen that these taxpayers, many of them move on to a new preparer. So they may not, our baseline year preparers might not even be aware of the audit. And finally, we've only at this point considered one type of Schedule C correspondence audit. There may be other types of audits in the network, which may in turn have also other sorts of general indirect effects. And they might also be propagating, which might confound some of our analyses, which leads nicely into areas for future research. We hope to quantify this general indirect effect in terms of dollars, so that we can use the findings that we've done here, this research, to actually inform research allocation decisions at the IRS moving in the future. And moreover, we hope to relax some of the assumptions that we've made around the baseline year and our mechanism, so that we can account for this lag in audit notification of 2 to 3 years, as well as different sorts of audit types that may or may not be propagating through these networks. And with that, I will thank you for your time. I welcome your questions and discussion, and I will pass it over to Paul for our next talk.
All right, thank you, Kyle. So thank you also to the conference organizers for allocating us some time here to share our work. So I'm Paul Organ. I'm a PhD candidate at the University of Michigan, and I'll be presenting some work studying a new enforcement tool that the IRS has recently implemented, and that's a tool that restricts passport access to seriously delinquent tax debtors. And this is joint work with Alex Ruda and Alex Turk at the IRS, and also with Joel Slemrod here at Michigan. And before I jump in, let me just say that the views and opinions I'm expressing here are mine, not necessarily the views of the IRS. So in today's talk, I'll give you a little bit of background and motivation about the passport program and why it might work and why we're studying it. And then I'll jump into our analysis, which talks about what the effects of the passport certification and revocation process are. I'll talk first about a subset of taxpayers who were certified and who we observe actually trying to do things with their passport. And then I'll zoom out to an RCT analysis of the more complete population of certified taxpayers. And at the end, I'll talk a little bit about putting that in context and what the policy implications of those results might be. So a little background on this program. In late 2015, as part of the FAST Act, Congress actually passed a provision that required the IRS to start this new enforcement tool. And what that tool would do is it would restrict passport access for seriously delinquent tax debtors. And what the definition of that is that it's a taxpayer who has total eligible debt of at least $50,000. So that could be across multiple tax periods, cumulatively above 50,000. And that's been indexed. So the most recent year, it's at 54,000 now. And also this is debt that has been through the normal collections process. So they've attempted a lien or a levy. They've sort of worked through the normal process and it hasn't resolved. So then they apply this additional sanction, this passport certification. There's also a number of reasons a taxpayer might not be certified. So if they are excluded because they have, they're currently not collectible for hardship, or they're in bankruptcy, or if they're working on their debt, they're in an installment agreement, something like that, they wouldn't be certified. So this is really meant and designed to target taxpayers who are not compliant, are not paying their liability. That's who would get certified. The consequence of getting certified is that if a certified taxpayer tries to get a new passport, that would not be approved by the State Department. And also if they have an existing passport and need to renew it or make changes to it, that would be denied as well. In some certain cases, taxpayers can actually have an existing passport revoked, but those are a relatively rare set of circumstances. So stepping back a little bit and just thinking about like the motivation for this tool. Why might we expect a passport tool to work different or better than other tools? And so we think this fits in a category of tools called collateral sanctions. So these are sort of separate from a lien or a levy or a typical financial penalty. It's something else. It's like an additional penalty that's applied on top of those typical tax penalties. It's going to take away some sort of government benefit or privilege. And usually it's going to be require the cooperation of another agency. So in this case, the IRS works with the State Department to enforce this passport. I'll talk about a couple of other examples where it requires that cooperation with another agency. So there's been some theoretical research saying collateral sanctions might be more effective or effective in different ways from monetary penalties. So one reason is they might be more salient. So in dealing with taxes and penalties, all of that is related to financial stuff, but the passport feels different. You notice it and the taxpayer notices it and so responds more. It might trigger loss aversion by taking away something that the taxpayer had. They had a passport and they no longer are able to use that potentially. And it might have some reputation effects, just differently than a financial effect. So Kuchimova has a paper also that formalizes in a model why you might expect a collateral sanction to be useful. And basically the point there, I think, is that it allows you to tag taxpayers that maybe it's more efficient to target for enforcement. So with passports, perhaps on average, wealthier taxpayers or higher earning ability taxpayers might have passports. And so by applying a sanction on passports, you're able to tag those taxpayers. So at the federal level, there are some other examples of these collateral sanctions, and there are quite a few at the state level. So for instance, some states will restrict hunting and gaming permits or professional licenses, depending on the amount of tax debt, that state tax debt that their taxpayers have. But we think this is kind of the first study of a large scale federal collateral sanction. Okay, so looking at the actual rollout of this program. So I'll highlight a couple patterns here. So the y-axis here is the monthly count of individuals who are getting certified. In gray are individuals certified for the first time. And in orange, some taxpayers cycle in and out of certification. So they get certified, either take some action or some change happens where they are decertified, and then they're subsequently certified again. So that's in orange, the subsequent certifications. And what you can see here is at the left side here, so early 2018, this is the rollout of the program. And there was a big stock of taxpayers who met the requirements for certification, because you could imagine, had this program been in place for years and years and years, a sort of normal chunk of people would be getting certified each month. That wasn't happening because the program wasn't in place. It only was passed in late 2015 and started being implemented in 2018. So that big stock is what we see on the left. After that big stock is certified, then we enter what we would sort of call the flow period, where now we're just certifying those taxpayers that newly become eligible for certification each month. And so you can see that's like a smaller number, you know, between 5,000 and 10,000 maybe each month. So the commissioner alluded to this a little bit in his remarks actually about the types of taxpayers that we're observing getting certified. So this is just providing some summary statistics of all first-time certifications through April 2020. So through that time, there are a little under 400,000 taxpayers that had a first-time certification. And for those taxpayers, on average, their total assessed balance, penalties and interest, so the balance that's relevant for this program, was a little under $200,000. It's a somewhat skewed population where you can see that the median balance was a little under 100,000, but this is still a pretty large liabilities here. You can also see here that it's not just one module. Often it's many years of unpaid balance that are accumulating to this high amount, and that on average, the oldest module for these certified taxpayers is 7 years. So often it's older debt that's been sitting there for a while. We also take a look at the income of these taxpayers. And so we see that there is quite a bit of variation there too, but on average, these certified taxpayers are relatively high income. So average AGI in the year prior to certification is a little over $100,000. And again, that's a little skewed where the median is lower at 60,000. Okay, so jumping into our analysis of the effects of this program, the first group that we study is this subset of 12,000 certified taxpayers who made requests to the State Department and were denied. So we think this is a really interesting population to study because we know these are taxpayers who wanted to do something with their passport and were unable to do it because of certification. So if you just think about applying this sanction of certification to a randomly selected taxpayer, it's not necessarily the case that that taxpayer has a passport or wants a passport. If you look on average in the United States, a little less than 50% of individuals have passports, and most passports last for 10 years if you're an adult. And so even if you were certified and if you had just renewed your passport, you might have 9 years left potentially on that passport before you think that you really need to do something. So it's not going to be that every certified taxpayer is fully treated. There's going to be some variation there. But this group is a group that we know is fully treated. These are the taxpayers that were certified and tried to do something and were denied. So we think this is a great opportunity to study a really direct effect of the program. What we're going to do is observe these individuals' behavior before and after their request to the State Department that was denied. And we're going to compare them to a control group. And we've selected this control group very intentionally to remove or allow us to remove a mechanical effect of this before and after behavior, which I'll show you on this next graph. So this is a graph showing on the y-axis the share of each of these two groups that are getting newly decertified in each month. And the x-axis is months relative to a denial. So the orange group is those 10,000 individuals who we identify as having made a request to the State Department, and we define their month when they were denied as month 0. And this control group is going to be a group of taxpayers that also were certified at that same point in time. And so that allows us to condition on having been certified at the same point in time. So we're teasing out this mechanical effect that if I just condition on you being certified, that's conditioning on not having taken a bunch of actions in the past. If you had taken a compliance action in the earlier months, you would have been decertified. So this lets us capture that mechanical effect, which you see by the gray line. So by conditioning on certification, we see a mechanical jump up here. But for the orange group, the state denied group, we see a much larger increase. And we attribute this difference between the orange and the gray to the effect of that passport request denial. And so you can see if you add it up over these couple months after state denial, a pretty significant difference on the order of 20 or 30% if you went out to 6 months between these two groups. So this suggests the denial is leading many individuals to take immediate action. And I'll go into now what those actions are. So here we're splitting out a couple specific compliance actions. The top left panel is starting a new installment agreement. And that's the most common individual action that a taxpayer responding to the denial takes. So you can see here in that first month after denial, more than 4% of that state denied group starts a new installment agreement. So that seems like sort of the main way. And that's a positive compliance action. These are taxpayers who had a debt that they were liable to pay, had not taken action on. They go to the State Department and make a request and are denied because of certification. And then the very next month, they enter into a new installment agreement. We also see some other actions. So OIC is offers in compromise. Note that each of these scales are independent. So here, this is 1/10 as large. I mean, there is a significant jump there, but it's on a much smaller scale. There just aren't as many OICs in general. We also see a good chunk of the state denied taxpayers that are newly designated as currently not collectible due to hardship. And so that's another way that a taxpayer could get decertified and be able to make those passport changes that they need. And so that might be that these are taxpayers who previously maybe would have considered applying for hardship or needed to get forms in order or something like that. And as a result of needing this passport request approved, but being certified, they're able to somehow get things together and get that designation. We don't really see much difference on bankruptcy, although that is another way that a taxpayer could get decertified. So the other thing we look at is payments, which might be the most obvious way that you would think a taxpayer would respond to certification. So if they're certified, they could just pay down their debt. That's going to be an option that's available to some individuals if they have that flexibility to pay. And we do see in this top panel a significant difference between our control group and that state denied group. But note the scale. So this is about 0.5% of the group that are paying down. Over time, I mean, that adds up if we integrate it here, but it's a relatively small chunk of people. But because these debts are so large, that's a potentially large amount of revenue. Even if you only have 1 or 2% of people, but they're paying in full on, $200,000 of balance, that can be quite large. And we talk about that in the paper. We also see some that are able to go to zero assessed balance by abatement. So that's another option too. And we see a little bit of that going on. All right, so then I'm going to zoom back now to our other analysis, which is looking at certification more generally. So that state denied group are the folks that we know had or wanted a passport. Certification is applying to everybody, the several 100,000 people that were certified. And to study this group, we're going to exploit a nice feature of the rollout of the program, which is that a small 5% chunk were held out intentionally for research purposes. So by using a social security number this 5% randomly selected group of individuals who were eligible to be certified at that time were held out and not certified. There's a small quirk, which is some taxpayers cycle in and out of certification. And so that holdout occurred the first time they came up as eligible. But if they came up again later due to some changes in their account or something, they would be certified that second time. So we have a little bit of what's called treatment migration, where that control group, some of them do get treated during our sample period. Luckily, this is a problem that exists in many other studies, and there's tools to address this. So we rely on this Ingres 2005 approach. We're going to use an instrumental variables approach to address that. So here's how that looks in our study period, is that first year of the program. And really that's going to be mostly this group of the stacked taxpayers. And you can see this treatment migration in the right panel. You can see our treatment group in red. All of them are certified by the end of that first year. In the blue are the control group who by social security number were intended to be held out. And some of them end up migrating into treatment, into being certified. So by the end, we have about 20% of our control group treated. But like I said, we can use that instrumental variables approach and recover a causal effect. So that's what we'll do. We'll use social security number as an instrument for certification and recover a causal effect of certification on various outcomes, similar outcomes to what I showed you before. We study a sort of restricted sample, somewhat restricted sample, where we focus on taxpayers with balances, total balances less than $1 million, sort of just excluding outliers in this, although we do quite a bit of robustness checks in the paper to make sure everything's robust to these changes. So looking at the results. So this is sort of our main table of results where we're studying during the period after certification, were taxpayers who were certified more likely to take various actions. And these are the actions I showed you for state denied. So starting a new installment agreement, new offers in compromise, and new currently not collectible for hardship. We find significant positive effects of certification on these outcomes. We do not find significant effects for bankruptcy or for full resolution. So the full resolution difference we saw for state denied, where it was this really strong treatment, we don't find that now in this sort of less weaker treatment of certification. And we find sort of if we do a combination outcome, we find significant effects there too. So it looks like although certification is applying to this larger population, some of whom are going to have or want passports and some not, we still find significant effects in that larger population, even not just focusing on the ones who we observe with the State Department. So that's a positive outcome here. And I just want to emphasize again that there's this difference between this one-time rollout, this stock. So that's kind of it's a useful thing that this tool could be used potentially to encourage those taxpayers to come into compliance. But in thinking about what's going to be the future effect of this program or an estimate over an annual future, it's really going to be more useful to look at this ongoing flow. And so in the paper, we split things out that way. Just because this is giving you a better sense of sort of in the steady state going forward each month, what are we going to be looking at? All right, and thinking a little bit about just trying to put this in context. So if you were to try and get a revenue estimate from this or think about a cost benefit analysis, something like that, we can use our analyses that I showed you before to pin down a number, at least an estimate of a number on what's the dollar effect of these things. So when we look at the denied requests there, we can compare payments over the following year or 2 years for those state denied versus the control group. And when we do that, we find among the pre-existing cases, we find a smaller effect of about 7,000 versus 12,000 for new cases. And we can do the same thing for certification. Again, we find that those new cases, a stronger effect there. And that finds that a certification looks like it's producing about another $1,000 of payments. So just to wrap up, we find that the passport program is a pretty effective collateral sanction, both on the strongly treated group, but also on the more broadly more weakly treated certification group. The paper has a bunch more, and that'll be out soon: heterogeneity analysis, robustness checks, etc. But we're really welcome your feedback and comments. Thank you.
Hi, I'm Alex Yaskavage. I'm from the Office of Tax Analysis at the Department of the Treasury, here to present this paper on EITC dynamics, both of claiming and of paid preparer use. This work is joint with Emily Lin and Ankur Patel, both at also the Office of Tax Analysis. But I want to be clear that nothing here represents the views of Treasury or Office of Tax Analysis, just what we've found as researchers. So our goal in this paper is threefold. First, we're interested in plotting out the dynamics at the individual level of how people choose to claim the EITC and the way in which they choose to claim it using either paid preparers with credentials, paid preparers without credentials, or themselves either e-filing or on paper. After we lay those out, we want to understand what's driving those trends, with the ultimate goal of understanding how those trends also relate to compliance. In doing so, we identify a couple interesting points. We're able to identify a certain degree of EITC churn, people going in and out of participation in the EITC in a way that we hadn't previously been aware of. We see a large unexpected shift from people using credentialed preparers towards using uncredentialed preparers. And finally, maybe our most important finding is that we find that current claim compliance depends very strongly on your history of claim compliance in a way that seems to be independent of the actual choice of preparation method or claim submittal. So what is it about this nexus of tax preparation and EITC compliance that we're interested in? So EITC compliance has stayed pretty stable over the past 20 years, which normally is not a very interesting research topic, but the EITC is different. So like the commissioner mentioned, EITC claims are complicated. They involve definitions that are different than show up elsewhere on a tax return, definitions of things like income, dependents. They require making not quite judgment calls, but very in-depth knowledge of how long different people have lived with you, if they've lived with other people. They could potentially contain information that conflicts with what other taxpayers are reporting. And so they're very complicated, especially when you consider the fact that most people filing for the EITC aren't people who are also dealing with real estate transactions or something complicated like that. These are generally relatively simple returns, but of course there's nothing comparable to a W-2 where you just copy it over onto your EITC claim. So these are complicated forms for people who don't have experience dealing with complicated tax returns. That means the knowledge base of how to fill out an EITC claim is important. That knowledge base consists on the one hand of people who have filled it out before, and for the people who haven't filled it out before, the knowledge that their tax preparer has in preparing it for their other clients or through education, dealing with the IRS, things like that. Now, both of these things, the way that people have been interacting with paid preparers and the pool of EITC participants have been changing over the past 20 years. So the fact that we don't see any change in compliance either means these aren't as large factors as we initially assumed, or we're misunderstanding how to link this knowledge of the EITC with compliance. Now, we're not the first ones to work on any of these topics. It's well known that the effect of tax preparers on compliance is complicated. Some studies find that they increase it, some find that they decrease it. Most studies find a mix, which is not surprising when you consider that tax preparers are balancing, I want to get a good return from my client, but I also don't want to get them audited, but I also am trying to follow certain professional obligations. And so there's no straightforward relationship between using a tax preparer and ultimate levels of compliance. What we do know is that along a variety of measures, tax preparers who have more credentials and more experience tend to make fewer mistakes and show up less frequently in studies of audit and preparation errors. We also know that the individual knowledge base matters a lot. You might be familiar with studies that find people who live in areas where there's a lot of other folks claiming the EITC are a lot better at optimizing their own EITC claims. And so we know these things matter. We're just not sure how they all fit together. And that's what we're trying to do with this paper. So the data we're going to use for this is Irs Administrative Data from 2010 to 2018. For most of the paper, we're going to be dealing with a panel of people who claimed the EITC in 2010 with qualifying children. This is going to give us a very large sample of people to work with, even if we take a 2% sample of them. We're going to follow them from 2010 to 2018 using reported data. Normally, when we look at things like compliance, we'd like to be able to use some sort of audit data to compare what's reported and what is ultimately determined valid by the IRS. We don't have data like that in this case. Instead, we're going to use some indirect measures of compliance that I'll get to later in the paper. The important thing is that right now, everything we're seeing is going to be reported by the taxpayer. And before we get into looking at the panel, first, I just want to show you the historical data that sparked some of our interest. So the first two columns show you the overall number of EITC claims going back to 2003, and the percentage of those claims that are made by people who hadn't made a claim the year before. You can see some trends, goes up, goes down, nothing particularly notable there. What's a little bit more interesting are the next three, which look at how EITC claimants were filing their returns. Back in 2003, about 14% of the population was e-filing who claimed EITC. Most of it, 3/4, was using a paid preparer, either credentialed or uncredentialed. And then another 10% were doing it on paper by themselves. By 2018, the fraction that are e-filing had tripled. And the number using any preparer had also fallen. And if you do some subtraction, you see the number of people filing on their own on paper drops to almost nothing. So we know that e-filing and using paid preparers are very important and have gotten more important over time for EITC claims. The other interesting trend we see is, you can see starting in 2010, we have some information about preparer credentials. These are preparers. We have some information that's voluntarily submitted about preparer credentials. And the fraction of the returns being prepared by preparers where we either don't know or have no credentials appears to be falling over time. But since overall preparer use is also falling over time, it's hard to tell if people are switching to uncredentialed preparers, if it's staying the same, or what's going on. Part of that is because we have these composition issues when we're looking at these overall trends. We're dealing both with how individuals change their behavior over time, but also the behavior of new participants versus old participants. You can see there's always a lot of new participants in the EITC. And so it's hard to tell what individual people are doing by looking at these aggregates. That's why we focus on a panel. So first, I want to briefly talk about transitions in claiming decisions. So if you look at this, this is using the panel data of people who claimed EITC in 2010. In 2011, about 78% of them claim it again. About 22% stopped claiming in 2011. So they claim it in 2010, not in 2011. Where it gets a little bit interesting, in 2012, again, of those 78%, some of them are claiming it again. About 15% of the overall population are not claiming it. And then 6% resume claiming it after not claiming it the year before. And if you go down, you look all through 2018, this trend of a large chunk of the people who stop claiming in a given year, the 14%, 12%, 11% as you go down, are offset by some degree to this 5 to 6% of individuals who resume claiming who had stopped. So that tells us that just looking at that share of new participants to get a sense of how much knowledge there is in the EITC population is misleading. There's quite a bit of cycling in and out. What we can't tell with this is if that cycling is limited to people who are near the threshold, and so some years they're over the EITC threshold and other years they're not. We can't say that with this analysis, but we can say that 20 to 25% of new participants you see actually has a bit more information about the EITC than you would expect. What we're more interested in are the patterns of transition in preparation methods. So we're broadly going to consider two classes of paid preparers. There's the credentialed preparers, and these can have a professional certification like a CPA or a law degree. They can have something from the IRS. They can be an enrolled agent, for instance, or they might have a state level certification. The rest we're going to label uncredentialed or unregulated preparers. These are preparers who don't report any sort of credential to the IRS at any point in any of the data we're able to find on them. Also, we're going to look at e-filing, and in this time period, e-filing is going to be pretty synonymous with filing on your own at all. Like I said, it goes down to 3 to 2% during this time period, where we're looking at 20 and 10 beyond. That's where we have this information on the credentialed and uncredentialed preparers. So this chart is similar in some ways to what was shown in the first presentation, but instead of looking at how people stay with a specific tax preparer, this looks at how they stay with a certain class of tax preparer. So you can see in 2010, we had about 63,000 people in our sample who were using a credentialed preparer. In 2011, there's some attrition from the sample, people who stopped claiming the EITC. So we have fewer people claiming the EITC. It goes down to about 47,000. And about 3/4 of the population continues using a credentialed preparer. But then you also see almost 20% switch to using an unregulated preparer, and about 6% start self-preparing. Because of how we construct the sample and because of some persistence in people's behavior, we might expect people to be sticking with credentialed preparers at a relatively high rate early on. By the time you reach 2018, less than half of the people who started out with a credentialed preparer are still using one, and almost a third have switched to an unregulated preparer. This is comparable, in fact, a little bit higher than the share that are shifting from using a preparer to e-filing. So if you thought the shift to e-filing was interesting, you should also think that the shift from regulated to unregulated tax preparers is equally interesting. And the reverse does not happen. We see when we look at this similar type of table for other preparation types, almost nobody switches to a credentialed preparer once they start using either an unregulated preparer or they start self-preparing. So this is that large shift I mentioned at the start, where people at the individual level are switching to unregulated preparers over time in a way that's kind of obscured if you're just looking at the aggregates. Now, we might be curious why people are choosing to use paid preparers. So I'm just going to talk here about the decision whether or not to use a paid preparer at all. So we're grouping in credentialed to uncredentialed preparers here. First, we just run a regular OLS linear probability model, regressing your decision to use a paid preparer against four things: against whether or not you used a paid preparer the year before, the number of times that you've used a paid preparer in the past, whether you filed an EITC claim the prior year, and the number of times you filed an EITC claim in the past, as well as a bunch of demographic controls. And we see that your decision to use a paid preparer depends very strongly on if you used one last year, moderately so on the total experience you have with paid preparers, and a little bit, but nothing too major on your EITC claim history. But when you see this large correlation over time, you should get suspicious and say, well, maybe there's something that's driving this. So we include fixed effects here, and we see that, yes, there is big selection based on presumably something like risk parameters or how complex your tax return typically is. The significance, the coefficient on whether or not used to prepare last year drops. Interestingly, the coefficient on the number of times you've used one in the past rises, which is consistent, at least, with something you might expect if there's variation in how comfortable people feel switching from a paid preparer to doing it on their own. So we're definitely picking up some selection effects there. But in the interest of making it to the end of the presentation, I want to jump ahead to compliance. So we're going to use two compliance flags here developed by Emily Lin to measure whether or not individuals are complying without actually being able to see the results of an audit. So we're going to, first of all, construct a flag for whether or not they violate any of the rules in the dependent database, which is the IRS's system for determining whether or not you have met the qualifications for an EITC qualifying child. If you have any violations in that database, we will consider that a flag. We will also construct flags using the 80th or 90th percentiles of the DIF score, which is a score that the IRS calculates and uses to determine audit decisions. So just to show you that these do correlate with actual audit outcomes, we match it to randomized audit data in those years where we have it. And you can see that, first of all, in the EITC column, people who have the DDB flag tend to have a $600 smaller EITC after they've gone through this audit. They tend to have a smaller EITC of $50 to $200, depending on which DIF score flag they have. So both of those flags seem to predict the results of the audit to some degree. Also, if we take a look at total tax before credits, we see that the DDB flag and the DIF score flags, again, predict owing more in tax after the audit, but unsurprisingly, the DDB flag is not particularly informative compared to the DIF score flags because total tax before credits obviously does not include EITC. And we unfortunately don't have a clear idea of what we should expect on the relationship between both past claim behavior and past prepare usage. On the one hand, getting your tax return prepared gives you a lot of information to reference in the future when you're filling out your return. On the other hand, if you go to a preparer, as we saw, you're probably self-selecting on things like risk or how complex your returns are. We're also not clear, there's no obvious answer for how personal experience filling out the tax return on your own over time affects things. Understanding how the process works can either be used to better comply or to get away with more things that you think the IRS won't catch. So we go into this without a clear idea of what we're expecting on the compliance side. So here, and I apologize, I appear to have swapped the titles on these columns. The first set of columns shows the results of running a regression, regressing either of these flags against the number of times previously you have claimed the EITC without incurring a flag. The second two set of columns show you the results of a regression where we include flags for having submitted EITC claims that do raise flags. So as you can see, submitting claims that don't raise flags have a negative effect on your likelihood of throwing a flag this year. People who put in returns in the past that don't raise flags in the future. And of course, the opposite is true with claims that do have flags, and it's fairly significant. Submitting 3 prior returns that throw flags make you over 20%, or about 20% more likely, 20 percentage points more likely to throw a flag this year when you submit your claim. On the other hand, when we do something similar, adding in your history of filing with different types of preparers, and again, sorry, I switched the titles on these two. Claims submitted by either self-prepared, credentialed, or uncredentialed preparers that don't raise flags have no effect that we can find on outcomes. There is an effect when we look at prior returns that throw flags filed by self-prepared, credentialed, and uncredentialed preparers. But compared to before, where we were talking about 10 to 20 percentage points, the difference between preparer types is very small here. It's inconsistent, and so we're reluctant to draw conclusions right now from these results. So when we put these all together, what do we find? First, we find at the individual level, people tend to shift away from credentialed preparers over time. Preparer credentials do affect outcomes, but only to a very minor degree. More importantly, current compliance depends very strongly on past compliance. And I'd just like to point out everything we've talked about here is correlational in nature. Future work will involve addressing causality with IV policy changes and so on. And from there, I will turn it over to Tatiana to discuss these papers.
Great, thanks so much. And thank you for having me discuss these amazing 3 papers. I learned a lot that applies to my own work and about policy areas that I didn't know as much about before. I think I've got, there we go. Okay, so first talking about the first paper that Kyle presented about audit contagion. So, he sets the question up very well of saying, there's this large literature about the direct effect of audits and also about the specific effect or of a specific indirect effect of these audits. But there's a lot less work on this general indirect effect or spillovers. So there's a small literature about geographic network spillovers, but there's this newer literature that's suggesting that tax preparers might be a really important network as well. And so that's exactly what this paper is thinking about. Are other taxpayers in my tax preparer network, is their audit experience having spillover effects on my tax behavior? So what they're going to do in this paper is compare audit eligible taxpayers who did not experience an audit themselves, but did have another taxpayer in their tax preparer network who did experience an audit. And I've copied the sort of main findings figure here as well that shows the difference in total tax collected for those who are in a treated network. So taxpayers who did not experience an audit themselves, but did have another taxpayer within their tax preparer network who did experience an audit, and control network. So again, audit eligible taxpayers that did not have an audit in their tax preparer network. And you can see that the blue line, the control line, is relatively flat throughout these 7 years that they're able to follow their taxpayers. But we see that those in the treated network see a pretty sharp increase in the amount of tax collected after that baseline year, sort of consistent in what you might expect of there being some importance of these specific indirect effects. So again, going back to this identification strategy, they point out that this is much better than an alternative identification strategy that would just compare audited taxpayers to audit eligible taxpayers, because these might be very different people with different characteristics. So there's certainly going to be less selection bias when we're comparing these 2 types of networks rather than audited versus non-audited taxpayers. However, there's still potentially some key differences. And they show this in the paper, that there's a lot of characteristics where these two types of networks aren't balanced. So taxpayers in the treated network have a higher audit probability. As you could see in the graph that I put on the previous slide, they remit 29% less tax in the baseline year, and various other types of characteristics. They seem to be different. So it does seem like there's a bit of selection still remaining here. And that might sort of correspond to the somewhat puzzling result that Kyle was talking about, where if you are breaking that main result out by how long an individual stays with their tax preparer, you see that the effect is strongest for those who only remain in that tax preparer network for a year. And that timeline that Kyle laid out was really helpful to think about exactly when we might see changes in taxpayer behavior taking place, because these audits typically take place roughly 2 to 3 years after the tax return is filed. So we see the largest results among those who have made a tax preparer network switch before the audit information is actually revealed. So that sort of led me to start thinking about, well, what are some of these other types of identification strategies that you guys could use to try to get over some of these potential underlying differences between your treatment and control networks that might be driving some of the puzzling results. So I was wondering if there's other types of matching strategies that you could use to create sort of a more balanced comparison of networks. Alternatively, you could think about using the specific timing of the audit as your variation. So restrict it only to these treatment networks, but then utilize the timing and when the audit occurs and when information about the audit takes place as sort of an alternative identification strategy. And then I started thinking about mechanisms, and some of these questions here might just come from my inexperience with thinking about how tax preparers are really sort of trying to make their decisions about how they're filing these claims. So you sort of set out saying that, a very reasonable assumption that the tax preparers are informed about the audit from the taxpayer. And so that the behavior change is coming through that tax preparer. An individual taxpayer gets audited, the tax preparer is then informed about it, and so that tax preparer makes changes in how they're claiming for others in the network. So again, in the back of my mind, I kept wondering sort of what is the objective function of a tax preparer rather than for an individual. It's you want to get the best outcome on a tax return, but you also want to balance that against the fear of audits, and sort of spelling that out a little bit more for the reader like me would be really helpful to think about what would we expect the tax preparer to change once they are informed about an audit of a return that they had handled. I also started thinking about sort of other types of information spillovers. So you sort of are positing that the information is going from the audited taxpayer to the tax preparer. But I was wondering if the other individual taxpayers in this network also might be receiving that information, or is it just that the information is going solely to the tax preparer? So if so, also that's maybe something that sort of filters into this objective function for the tax preparer, that I might have to worry about reputational concerns if I'm a preparer who has people in my network who are getting audited. So I thought that this might be something that was potentially testable. So if taxpayers are learning about audits in their preparer network, that might have an effect on their likelihood to stay with that current preparer, and might feed into some of the dynamics that you see, which you're in your descriptive analysis of how long an individual stays with a current tax preparer. Those two things might be related. So I thought that might be interesting to think about and potentially test. Moving to the next paper, do collateral sanctions work? So this is a paper that's estimating the effect of a new collateral sanction program, which revokes passport access for individuals with substantial tax debt. So I thought this was really interesting because most of my reading and some of my own research is really focusing on these sort of more traditional forms of sanctions, like fines, penalties, and so thinking about other mechanisms to increase compliance among these sort of large debt holders is really interesting. So this is a really action-packed paper. In fact, Paul didn't get even a chance to talk about the third analysis in here. So again, there's an RCT during the rollout of the program, measuring that direct effect for the total population of people who are eligible for this certification. There's an event study that's following individuals who are actually trying to renew a passport or get a first passport. So sort of a higher impact sample because as Paul very clearly pointed out, you can hold on to a passport for a very long time. And so this sanction might not be binding for you for quite a while. So focusing on that event study of a high impact sample of people who are actually trying to gain passport access and getting denied is a really helpful complementary analysis to the RCT. Then the third analysis is trying to think about some of the indirect effects using a bunching analysis around that eligibility threshold for this certification kicking in. So quick summary of results of the RCT finds small but significant effects on this full population, and then much larger effects for those who this is really binding for, those who are actually seeking passport access and getting denied. And then there's somewhat inconclusive effects on the indirect effects of the program. So I wanted to highlight, and I think Paul did this very well, to talk a little bit about who exactly this target population is. So to be eligible for certification, you need to have a substantial amount of debt, but then also have gone through a lot of the traditional tax collection processes. So this is a group that I might have imagined is just extremely difficult to move, which makes it all the more surprising that you find quite substantial effects and sort of highlights how clever thinking about these types of collateral sanctions programs can be to move these seemingly immovable taxpayers. But what might be really helpful to add to the paper is a little bit more description on exactly who are the individuals who make it to this stage, and especially for thinking about comparisons to other types of compliance incentives like fines. How does this population compare to other populations that have been studied for these other types of incentives? Then both of these points here, I'm realizing that you did not talk about in the presentation, but you have a heterogeneity analysis by income for your RCT, which was really interesting, showing that a lot of the effects are driven by those who are higher income. But it was somewhat difficult for me to disentangle that higher income being a proxy for passport demand. So it's higher income individuals who are going to find this sanction binding versus ability to pay. But potentially that's an analysis that you could do with your state denied that event study analysis too, because these are clearly all individuals who are seeking passport access. So it could really be targeting that ability to pay question. On the indirect effects, so this bunching analysis to see are individuals sort of bunching their debt just below this eligibility threshold. You show this nice bunching analysis by year, and it looks like there's some sort of overlap with a policy that you describe about this installment agreement having a similar threshold, making it really sort of difficult to disentangle. But I was wondering if you're able to difference that out using the pre-period years. And separately, this sort of highlights a point that this installment agreement policy seems to be worthy of study as well, because you see some interesting bunching around that too. So then for the last paper on EITC non-compliance, so this is a paper that's examining the relationship between EITC non-compliance and tax preparation method, as well as prior non-compliance. So the paper finds that non-compliance is highest among new claimants, among prior non-compliers, among users of unregulated preparers. Sort of small flag on that. It was really interesting that unregulated preparers are the most common method in most of the years that you study. And I didn't really have a good qualitative view of what an unregulated preparer is. Is this just a small CPA that does not, get regulation through the IRS because they just didn't file it, or again, just not sure exactly who I should be thinking about these preparers being. And you find lowest non-compliance among those who are VITA and TCE users and prior compliers. So selfishly for my own work, I found the results on compliance by preparer type really interesting. And again, this was a table that I don't think that you included in your presentation, but I welcome people to check out the paper. So I've got some work that was presented at this conference in a prior year, analyzing an IRS experiment, sending prior non-filers information about free tax prep methods, so VITA and TCE or the free file program. And we find significant increases in filing and in turn, significant increases in EITC claiming. So what's sort of interesting there is, we may be shifting these prior non-filers who may have used a certified preparer or an unregulated preparer towards using one of these free prep methods, and understanding a little bit more about the compliance on the EITC claiming of these different types of preparers was really informative for what we found, suggesting that if these are individuals who are now using VITA or TCE, they may be not only more likely to claim the EITC, but more likely to be in compliance as well. Then I'll quickly finish up here, just saying that in the paper it seemed like some of the persistence that you were finding was often characterized as learning. So I learn about being compliant, or I learn how to be non-compliant. And I was a little bit confused if that was indeed learning versus just I do the same thing every year. And so it's really just persistence in behavior. I love these new measures that you're talking about for compliance. And it would be a little bit helpful to describe how we should think about them differently if we see a certain effect on one type of flag, but not another. How should we interpret the differences across those two measures? And I will stop there because I think I'm over time, but these were fantastic papers, and thank you for sharing them with me.
All right, thank you, Tatiana. I'd like to give the authors or the presenters an opportunity to respond to the discussant's comments. I guess Kyle, you're up first. If you have any reactions or comments.
Yeah, absolutely. So Tatiana, you raised a lot of wonderful points that many of which we'll take into consideration in revising our draft paper. One, quickly going through my hastily jotted down notes. So your point on potentially controlling or matching different pair networks based on some sort of composition of these networks. We do a little bit of this already, although we did not call it on this presentation, in controlling for some of the prepare network characteristics in terms of controlling for the number of eligible or number of taxpayers who are eligible for this particular type of audit in the network. So we do already control for that, but there's definitely some other things that we can be doing to control not only for who we're, I guess, catching in our baseline year, but also understanding how this population is changing over time. As I look back down at my notes, yeah, so absolutely hearing you there, and that's actually an area I guess that we're hoping to expand on, and we're continuing to research this is relaxing some of this assumption around when are people aware of this audit, when are they, I guess, eligible for this audit, and does that affect how they're shifting preparers or moving to someone else. The final point I'll I guess raise or respond to is your point in spelling out the objective function of a preparer is very interesting. I mean, off the top of our heads, we kind of brainstormed, and yes, like preparers have been shown to like increase compliance in some areas, but also decrease it in other areas. So this mechanism that we've laid out of someone an audited taxpayer notifies their preparer, who then kind of disseminates this knowledge. We've assumed, maybe in the sake of us just having a story, that the taxpayer is not actually telling other clients like, hey, I got audited last year or 2 years ago, just for the sake of that seeming not like a great business motive. However, so then the knowledge becomes kind of implicit, and that implicit knowledge could drive that preparer towards filing or encouraging better, or I guess more compliant returns in future years. But it also could, I guess, give the preparer maybe someone with maybe sketchy or someone who's a bit more, I guess, risk-seeking knowledge of areas that this particular type of audit is looking into. So it actually might give these preparers tools to maybe avoid the audit in future years. So thank you for these comments and all the Q&A questions. We're looking forward to kind of incorporating it in future versions.
Paul, do you have any responses?
Sure, thank you. So yeah, thank you, Tatiana, for the comments, very helpful. I liked what you said about, it seems like this program maybe is moving the immovable, or the seemingly immovable, that it's having this effect on taxpayers who hadn't responded for a while. And so I think that also speaks a little bit to the commissioner mentioned, like, can't pay versus won't pay. And it seems like that's kind of a vague concept, but it seems like, at least in this population, there is some chunk that was a won't pay. And this is a tool that tipped them into paying. So I think that's an interesting feature. Learning more about who the certified taxpayers are, totally agreed. I think we could do more on that. I think that's an interesting feature of the program. When you talk to people, or when I talk to people about the program, and the perception of it, is it a fair, is it an ethical thing, that type of thing. I think when it's perceived as, well, these are mostly wealthy people, these are mostly high income people, if that's the perception, then I think it has sort of a general acceptance. But if that's not what's actually going on, or if there's a lot of variation, I think that would affect the perception of the program, as well as thinking about comparing the relative effect of this to other things that would be relevant to. Yeah, so totally. So on the heterogeneity, I didn't talk about that in my presentation, but something we do in the paper. So we don't know for each taxpayer, do they have a passport or not? But we observe some things, and we want to know, we want to find some proxies that are going to be correlated maybe with having a passport. And one thing is income. On average, higher income people are more likely to have passports. And we show the effective certification is higher for higher incomes. And I totally agree. And I think that's a great point, that we could, that could be ability to pay, and it could be passport proxy, and that we could look at that in the state denied. So that's a great idea. And I also agree on the streamlined IA. So the bunching thing, what we show is, in this presentation, I focused on the direct effects. What's the effect of getting certified or getting a denial? But you could imagine that this passport program could also have some indirect effects. It's an additional tool in the enforcement environment. And so a taxpayer who's thinking about how much debt to accumulate or when to pay off is going to be thinking, may think, well, down the line, if I don't pay off, I'm going to be certified. And so they might take actions now. Or they observe that the cutoff is right now $54,000. So maybe they'll pay down and just sit at $53,500 because they're worried about getting certified. So that's something we check for, and we don't see a lot of in the right now. But I think there's an interesting thing with these tax preparer networks and provider networks. As this information about the program is disseminated, you could imagine the indirect effects of the passport program actually increasing over time as people learn about it. But it is an interesting point, what we show in the paper, that there does appear to be bunching below $50,000, which is also a cutoff for streamlined installment agreements. And that could be a next project, maybe. That would be good. So thank you.
Okay, and finally, Alex, do you have any quick responses to?
Just a couple things. So first of all, on the issue of who is an unregulated preparer, it's a really broad bucket. It includes everyone from I know a guy, and as long as he signs his name at the bottom, that counts. It also includes a whole lot of like H&R Block employees who don't have a CPA, just work as employees for H&R Block. And we love to be able to differentiate between those two types a little bit more. Right now, it's kind of out of our control. And then your point about learning versus persistence is well taken. That I think is a little bit of aspirational wording on our part right now. And I think as we get into some more causal issues, we'll be able to investigate that a bit more closely. That's it.
Okay, great. So I'm going to read some questions from the audience. And the first question is for Kyle. At first is a comment and then a question. If preparers have been in a business multiple years and have many Schedule C clients, then they likely have audited clients from pre-baseline years. And so you likely have a set of pre-treated preparers in your baseline network. That was the comment. And then the question is, did you consider looking for a CAF indicator on the audited taxpayer's account as evidence that the preparer was directly involved in the audit to avoid the assumption of information sharing?
Yeah, absolutely. And both of those comments and questions are great. We did look briefly into a specific type of CAF indicator. We looked at the indicator for power of attorney to see if the preparer had the power of attorney to kind of respond to the actual audit on behalf of the taxpayer. Our analysis found that indicator was pretty sparse and limited in our sample. And we included it in some of the earlier models, but it ended up not providing any sort of statistically significant improvement to our model estimation. But I think your point is very well taken in that it would be really wonderful to know the extent to which our taxpayers in our sample are replying and interfacing with their previous preparer. So it's absolutely definitely an area of future research, either in an empirical quantitative sense or even a potential qualitative study.
Okay, and we have a number of questions for Alex. Do we have any idea what the overall market share of credentialed versus uncredentialed preparers looks like over time?
So we only have any sort of information going back to 2010. I don't want to give any actual numbers off the top of my head without having them in front of me, but there are a lot of uncredentialed preparers, partly because, like I mentioned to Tatiana, right now our measure of uncredentialed preparers is going to include groups like H&R Block, and so it's a very large share in general.
Okay. How much of the, this is also for Alex, how much of the churn in claiming is explained by changes in household or tax return structure? For example, single to joint, divorced, etc.
So we don't know, and part of the problem there is that some of those things are going to depend on what a tax preparer suggests you do. And so there are endogeneity issues in there that we haven't quite dug into yet. It's something that we would like to be able to address.
Okay. Another question for you, Alex. We know that EITC returns prepared by VITA are more compliant than any other mode of preparation. So why not just require all EITC preparers to do exactly what VITA does when preparing EITC returns? Is that so difficult?
I mean, we kind of do, because we tell VITA, here's the rules for filing an EITC claim. You should do that. And we tell the same thing to the preparers as well, the paid preparers. I don't know if there are like specific checklists or processes that VITA uses. I suspect part of the reason why just applying VITA processes in general across the board wouldn't work is because people going to VITA are self-selected to some degree. If you're going to a tax preparer who's looking to maximize your refund, they might just not choose to follow those procedures.
Okay. Another question, how are returns prepared with the help of various volunteer groups treated and identified? Some volunteers have considerable experience in training and some don't, and these returns may not show a tax preparer on the return.
So we don't know a whole lot about these VITA and TCE returns. What's supposed to be included on the return is identifier for the site location, not for a specific preparer. So we, even in ideal conditions, don't know specifically who at the site helped prepare the return. And it could have been a process where multiple people were involved in preparing the return. Right now, we just kind of group them all together because they make up a pretty small consistent share of these EITC returns over time. But I think, as Tatiana has pointed out, it is an area that we should be studying more closely. There's a lot of big benefits to understanding how VITA sites work.
Okay, I want to turn back to Kyle for a minute. There may be a cost to changing tax return preparers. Can you talk about taxpayers who stuck with their tax return preparers and those who did not in terms of this cost? I think maybe the question is thinking about maybe a hurdle model. Kyle, you're muted.
I am muted. Thank you. Sorry, I saw this question and right, indeed. So we did not think of, or we did not factor this cost into our models in the kind of this iteration. There are, we started looking into, I guess this might get at your question maybe indirectly. We started looking into some of the demographics of these taxpayers that are either remaining or are changing preparers. I guess almost related a little bit to some of the work that Alex was doing, to seeing if there's maybe some demographic differences or characteristics between taxpayers that remained with their preparer over time or those who did not. We haven't dug too far into that quite yet, but some of the early things we're seeing might be suggestive of some change in tax situation that might kind of be the impetus for changing the tax preparer, moving tax preparers. That doesn't feel like a very satisfactory answer to your question, but certainly something that we're keeping in mind, and thanks for that question.
Okay. Here's more of a comment than a question. As a VITA site coordinator, I think that at least anecdotally that Alex is onto something about self-selection. Also, I think that training that is provided by the IRS and the site visits that they conduct VITA preparers be vigilant in ensuring that returns are completed accurately. And here's another comment rather than a question. I do have concerns about using DDB and DIF as sole measures for compliance. These are both rule-based systems and do not have AI-type feedback loops. For example, they don't incorporate learning from cases where a rule is broken and EITC denied, but the taxpayer ultimately gets the EITC because of a TAS intervention or via audit reconsideration. And increase in self-preparation, some part of it is attributable to ghost preparers.
Yeah, so first of all, yes, ghost preparers are definitely an issue. Part of it is that by their nature, ghost preparers, in case anybody's not familiar, are people who prepare a return but don't sign their name at the bottom. So we have no direct information about which returns might be prepared this way. If it helps a little bit, a lot of these returns have to be going through e-file just because almost nobody does paper EITC returns anymore. Whether or not they're providing a value added over something like TurboTax, I can't speak to right now because, again, we can't identify them, but they are an issue that we are aware of. On the issue of diff score and DDB flag, they are definitely not direct measures. That's why we use them as simply flags. And it looks like you are about to say we're out of time.
Yep, I think we're out of time, Alex. That's exactly what I was going to say. I wanted to thank our presenters for presenting today. I think it was a great session. And we're now moving on to our next session, moderated by Mary Helen Risler.
Thank you. Good morning, and welcome to session 2 of today's conference. The topic is impacts of variation in process. For this session, we have 3 papers. The first, Sales Tax Administration and the Real Economy, will be presented by Roger White, Assistant Professor of Accounting at Arizona State University. The second paper, Using Discrete Event Simulations to Understand the Impact of Changes to IRS Process, will be presented by Raphael Decal, a Senior Operations Research Analyst in IRS's Small Business Self-Employed Division. And the third paper, Effects of Post-Filing Adjustment on Statistics of Income, SOI Estimates, will be presented by Chloe Gagan, an economist in IRS's Statistics of Income Division in the Corporation, Partnership, and International Branch. And our discussant for today's papers is Jennifer Stratton, a senior economist with the U.S. Government Accountability Office. Just a reminder that if you have questions, please submit them in the Q&A feature on the bottom of your Zoom window. We'll have time at the end of the presentations and the discussions talk to answer those questions. Thank you, and we'll turn now to the first presentation.
Thanks, Mary Helen. I appreciate it. All right, let me get control here. Awesome. All right, so again, thank you, Mary Helen. My name is Roger White. I'm an assistant professor in the accounting group at Arizona State University. This is joint work with two of my colleagues at ASU, Jenny Brown and Dave Kinchington. And our paper is titled Local Sales Tax Administration and the Real Economy. So to give you an idea, let's make sure we're rolling here. Yeah, awesome. Okay, so our big question is whether decentralization of tax administration imposes deadweight losses that measurably reduce business activity. And we're looking at local sales taxes, and we're trying to figure out whether local administration of local sales taxes as opposed to state administration of a local sales tax in our setting, which is Florida hotels, again, measurably reduces business activity. So to give you an idea of what sales taxes look like in the United States, right? Again, some of you probably work in this area, but for those of you that don't, there's about 10,000 different sales tax jurisdictions in the US, right? If we look, say at some place like Florida, in the bottom right of your screen, you'll see there's 67 different sales tax jurisdictions in Florida, because in Florida, sales taxes are set at the county level, and there's 67 different Florida counties. But if you look to the northwest just a little bit, in Alabama, there's 805 different sales tax jurisdictions, which is an absolute mess if you talk to anybody that works in state and local taxes in Alabama. And this is a function of Alabama local tax policy being set at the municipal level, right? So individual cities and towns in Alabama set their own sales taxes. So there's a lot going on here, right? But we're focused not so much on these individual jurisdictions or the sales tax rates as opposed to the administration. Right? We're concerned about who collects these local sales taxes. And in most states, no matter how many different jurisdictions there are, the State Department of Revenue is the administrator, right? So, the State Department of Revenue will collect, a state sales tax, and at the same time as they're administering the state sales tax, they'll also collect the local sales tax. And then after the State Department of Revenue collects all this tax revenue, they'll then remit the local portion back to the local governments. But in some states, local governments collect their own local sales taxes. So to give you an idea of what that looks like, in Alabama and what looks like Alaska, Colorado, and Louisiana, most local jurisdictions collect their own local sales taxes, right? And that's for general sales and use taxes, right? And that column to the left of this table. If we think about lodging, right? If we think about hotel taxes or bed taxes, there's 24+ states that require local administration of local hotel taxes, right? And so to give you an idea of how that works, so if we look at Florida, about a third of the way down in this table here. Let me see. Do I have a highlighter? Excellent. All right, cool. So if we're looking at Florida here, if you're a Florida hotel chain, say, and you operate in, say, these 40 different Florida jurisdictions, or individual tax jurisdictions, every month you've got to file 41 different sales tax returns, right? One for the state and 40, one for each of these different individual jurisdictions that administer their own local hotel tax. And so, if that sounds like a headache, I think you're onto something, right? There's some incremental costs here, right? Obviously, we're filing, many more returns. There's a lot of management time that goes into that. You're paying your accountant more, you're paying your attorneys more, you're having to, use more complex systems and more complex software. Also, those of us that have maybe, had the pleasure of interacting a lot with local municipal authorities, you might not be shocked to know that this information about, what the tax rates are, what the filing dates are, what the paperwork looks like, are tough to find or are not available from a central source, right? So you're having to go to, dozens of different, local revenue offices or local revenue, websites to figure out, how and when you're supposed to pay these taxes. You got to maintain different registrations, right? With all these different taxing jurisdictions, current addresses, current officers, current locations, things like that. Sometimes there's differences in the tax base between, the local sales tax and the state sales tax, which can be a mess. And then you've also got a variety of different enforcement procedures, right? If the locals are administering a sales tax, they're also in charge of the audits, the appeals, the penalties, that kind of thing. So instead of, again, one central authority, you're dealing with, local yokels on a jurisdiction by jurisdiction basis, which could be a mess. So how big are these incremental costs, right? KPMG put together a white paper a few years ago for an industry organization. And they just looked at the 5 states that predominantly have local administration of general sales taxes. And their estimate was across these 5 different states, annual aggregate incremental costs of local administration came to about $190 million, all right? And these are deadweight costs that would completely disappear if these 5 states shifted from local administration of local sales taxes to state administration of local sales taxes. So, on an individual basis, this comes out to about $500 a year per business in each one of these states. So our question here, our prediction is, if these compliance costs are meaningful and they meaningfully cut into profitability or prospective profitability for companies that are facing local administration of local sales taxes, then we'd expect there to be some kind of real economy effect, right? Are we going to see less business activity as a result of local tax administration? Does the deadweight costs of tax decentralization actually meaningfully affect the real economy? So that's our goal. So we're looking at Florida hotels. The tax we're going to look at is called the Florida Tourist Development Tax. You can think of it as a hotel tax, a bed tax. This is an incremental tax you pay on hotel stays. I guess it also accounts for private homes, Airbnb, private rentals, things like that. Short-term rental accommodations. So the Florida legislature introduced this tax in the late 1970s when tourism was really starting to pick up in Florida, and counties, tack their own tax on as well. So there's, this state level hotel tax, and then these counties introduced their own local level hotel taxes. Now, originally, both the state level tax and the local level tax were administered jointly by the state. So if you're a hotel in Florida, originally the way this worked is, you file a single sales tax return with the state, and then the state divvies up to the different local jurisdictions their respective revenue. Now, in the late 1980s, the legislature in Florida gave individual counties a choice as to whether they wanted to continue with state level administration of this hotel tax or start to self-administer their county level hotel tax, right? The state is continuing to administer the state level hotel tax, but now counties can choose to self-administer their local hotel tax if they would like to. So how does that look, right? So we look at switches for these counties that choose to move from state level administration of the local hotel tax to local administration of the local hotel tax. We think the setting is pretty nifty because it allows us to, holding tax rates constant. Does it matter whether you're dealing with just a single tax authority or whether you're having to deal with both the state and the local tax authorities, right? This is going to be a bump in compliance costs. It's going to be, a pain in the neck for managers. Is it going to meaningfully affect real economic activity? So to give you an idea of what this setting looks like, there's only 3 counties in Florida that to date haven't adopted a county level hotel tax. Those are the red dots. But there's, a dozen plus counties that still have the state administer their local hotel tax. So we've got this good control sample that kind of stays constant throughout our sample period. These counties in green switch from state administration to county administration of this local hotel tax in the 80s before our sample period starts. So they kind of stay constant in that treated group. But these counties in purple make the switch in the 1990s, and our sample period starts in 1990. So these guys all end up in our treatment sample. These orange counties have switched since 2000, so they end up in our treatment sample too. So we've got about 40 different county level switches, which is interesting. Now, why switch? Big reason is to capture this revenue more quickly, right? If the state administers your local hotel tax, they hang on to that money for about 3 months before they remit it to the local government. Also, this allows local government leaders to capture jobs in terms of tax administration. They're allowed to keep a certain part of these tax receipts to fund administration, and they like increasing the span of their control. So that's attractive. It also allows the locals to handle the enforcement and their audits. Hotel compliance is almost perfect throughout this sample period. They've got a big regulatory footprint, so they can't really hide and dodge taxes, but privately owned rentals can, right? And the state level tax administrators aren't going to start chasing down Airbnb hosts, right? And things like that. But the locals have a lot of incentive too, so they can kind of ramp up enforcement of these kind of smaller operators in this industry. So, that last point is really important, and it doesn't look like, hotel characteristics drive these switches, right? It's not like hotels aren't paying taxes and now we're starting to enforce that more. This is, this is driven by some other reasons, these switches from state to local administration. So any negative impact that we see on the hotel industry, we think we can attribute to, some unintended consequence of increased compliance cost. So we estimate county year regressions when a panel with 30-year panel of 67 different Florida counties, all 67 Florida counties. So we have about 1,500 observations, which is nice. And all we're doing again is predicting hotel industry size as a function of we've got this main effect of the tax because we want to control for the tax level, and then we also have this interaction term, which is our treatment effect, where we interact the tax with this indicator for whether or not this tax is locally administered, right? Does this matter? So I'm just going to show you the results for our hotel employees test, right? Our first column is just kind of the baseline model, and our second column, we put in just a measure of this tax, and it looks like, surprise, surprise, if we ramp up taxes on hotels, we're going to see fewer hotel employees in that county. And then in this third model, we break this out into local hotel taxes and then local hotel taxes that are locally administered with this interaction term. And we see that this negative coefficient is driven entirely by locally administered taxes, right? And so it doesn't look like, at least in this setting, it doesn't look like it's the tax rate that's deleterious to this local industry, right? It's not the tax rate that's imposing some kind of deadweight loss on this industry. It's the fact that these taxes are locally administered, right? That's really, really hurting here. Because we see, again, this main effect of this hotel tax rate is insignificant in this model, but this interaction term is powerful, right? So again, it looks like locally administered taxes are slowing down this industry considerably. So I know I'm running out of time here. Come on, awesome. So we do some dynamic difference and differences stuff. Doesn't look like there's a pre-trend. So again, to wrap up very quickly, it looks like compliance costs of tax decentralization discourage investment, discourage employment, discourage wages in the Florida hotel industry. Again, I just showed you some tests of employees, number of employees, workforce size, that kind of thing, but we see consistent results looking at these different dependent variables, right? So to give you, again, kind of a 30,000 foot view here, when we decentralize tax administration and we make this compliance process more complicated, it looks like this is going to lower real economic activity, right? It looks like, at least in our setting, there's some deadweight losses. We think this is an interesting contribution to the accounting literature because it's tough to find settings like ours where there's some switches where you can control for the actual tax rate and then see some variation in the level of administration, right? We're switching from state level administration to local administration and adding some complexity to this compliance task. And there is already a literature kind of on the complexity of this compliance task and whether or not it slows down economic development, and we think we contribute to that as well. So thank you so much. I know there's a lot of smart people out there listening right now that work in this area. This is a new paper, and I know Ginny, Dave, and I would be sincerely grateful for any feedback or comments you have. That you can either get into the chat box or just shoot one of us an email. So thanks so much. And with that, I'm going to turn it over to Raphael. Thanks.
Thank you. And thank you, Roger. And can you guys hear me? This is a quick check. All right. I will be presenting the paper on using discrete event simulation to understand the impact changes to the internal revenue process on behavioral on behalf of the IRS SP research. I also want to make sure that we give a little bit of credit to those individuals that participated in this research project. So Deandra Reinhardt, Ariel Wooden, Patrick Kaler, and John Curtis. And so with that, I kind of start with the discussion with this paper. Oh, here we go. Bingo. I seem to have problems moving.
Just be able to click on the slide.
I'm clicking.
Okay, just 1 second.
Move.
I'm in. Okay, try again. See if you can click on the slide. There we go.
All right, so there we go. Great, excellent. So again, sorry about that. Sorry about that. Let me get back to this. So now we're going to provide a little bit of background in terms of what this project kind of covered. This project was initiated mainly as a proof of concept. And the idea behind this was to determine whether there's any particular benefits to the individual working units within the IRS in assessing this particular type of method. And so this method was kind of implemented into the AUR, and AUR is basically a program that kind of uses third-party matching of individual and the generalized method. And what you're basically trying to do is you're trying to find out if there's any particular discrepancies between one individual's filings versus what was originally filed through that third party. And so, again, the discrete event was used kind of to assess this issues that occur when you try to develop some sort of pilot or experiment. And so when you try to implement these pilots or experiments, there are some associated downtime, some disruptions to services or lost productivity. And what you're trying to do is, hey, if you can develop these simulations, you're basically trying to reduce those disruptions and those lost productivities, which should lead to better, let's call it taxpayer service. All right, and so that was kind of the intent behind why we were running this particular experiment. And so in terms of our two objectives, so we had two objectives. One was to assess the efficacy of this particular method. And then the second one was to kind of estimate how changes in the AUR resources or processes could impact the AUR operation. And the way we would do this is through some experiment scenarios that we will run. And then that way we could determine if this thing is useful. All right. And so the market segment for this particular research project will be all AUR employees in the Philadelphia campus, as well as all taxpayers within the AUR inventory. And so It's important to understand that AUR does not only cover the campus in Philadelphia, but also other operations. And the idea here was to focus on Philadelphia since it's a proof of concept, and it becomes a little bit easier, more simplified model. And so that's the reason why Philadelphia was selected. All right. Now, then we get into the business process model and how it's developed. And the simplest way you can think about the AUR process models is think of kind of like a Visio type of process flow that you would create. And so again, it's at a high level or top level where you're trying to indicate how the particular work flows through the system. And so this you're trying to indicate where exactly you want to put the work, who's responsible for this work, and ideally you are trying to use BPMN standards, and you want to include a lot of your SMEs within the organizations to make sure that the process flow identical to what is intended or the way it works in the real world. It is in this area where you also try to identify things like the paths, which how it moves from one particular work to the other. You also try to identify individual data work that is necessary to be able to run this particular model. And so, let me see, yep, perfect. And so then once you have this process flow developed, now you have to kind of go and input this particular information into a simulation package. And so once you incorporate this particular model into the simulation, now you're able to make these changes to determine whether or not there are some benefits in the process change. And so while developing the executable model, again, this simulation model, the team would need to work to identify missing or redundant data. So as you start developing the model, you realize that you selected in the process flow of particular data sources that may not be useful once you put it into the simulation. And so it is at this point that you start working in identifying additional data sources that will be necessary to be able to run the simulation. All right. So once you have developed both, Once you have already worked on the executable model as the process flow, now you start beginning to test the process. And there are 4 things you really need to look at. One is fidelity, the other one is verification, validation, and lastly, calibration. And what's important here that some of these techniques that you're going to be doing, there could be simultaneously, and they require series of multiple iterations to make sure that the way you build that simulation model, it works properly and behaves the way it does in the real world. So the first thing you want to look at is that fidelity, and you want to evaluate the fidelity of the model. And the fidelity of the model, simply stated, is you're trying to make sure that the model that you have developed mimics the real world. And so if in the real world work goes from activity A or event A to activity B, you want to make sure that the model shows that same information and that there's no errors as you run the model. So that's the first thing in terms of validating the model. Then you also have to verify the model. And in this case, you're looking to see if the model meets the specifications of the system, right? And in this thing, you really, in this step, you need to ensure that the model is constructed properly. In addition, you need to start looking to see, hey, is this model that we've built, is it too complex or not complex enough? And in which case, you need to either add complexity to the model or remove some of the complexity to the model. And as well as adding complexity, you also need to go back during this stage of fidelity and verification. you want to make sure that you go back to your original set of assumptions and make sure that they are correct. It is possible that SMEs could have been, or subject matter experts could have had some ideas or self-perception as to what the productivity of particular individuals or what's the volume. And then you go back, you run the model, and the data does not match. And so at that point, you need to go back and say, hey, are your assumptions truly correct? Where can we find additional information? And how can we add this details or maybe complexity to ensure that the model works as it's intended? All right. And all right. Then we get into validation and calibration. Again, this is an iterative process, and they're all four are kind of interrelated. But in the validation process, you really have two methods of which you could use to kind of validate it. So the first one is what is a qualitative validation method. So in this case, the model has what is called in the literature high face validity. And all you're really doing is you're running the model and you are comparing visually with the graphs if the estimated or your predicted kind of match the actual data you have. And so in this case, for one example that you could use, suppose that you run your model and you see that the model that you have predicted, the data overlaps, but it appears to be 1 week behind or 1 week ahead. And that would be one way that you could determine that, hey, the model is behaving properly, but we must have some sort of glitches somewhere in there that is basically pushing our predictions 1 week ahead or 1 week behind. So that's the qualitative. Then you have the quantitative validation. And quantitative validation, you basically make some model assumptions, and what you're trying to do is to run a goodness of fit test or some sensitivity analysis to determine whether or not the model is properly predicting what you're trying to test. And so in this case, you could run a simulation model for years 1, 2, 3, and you could predict 3 months ahead. And what you could do then, you could wait 3 months, obtain the information that you have received 3 months later, and now you could test your predicted versus your actual to kind of determine whether or not they're statistically the same. If they are not, then now you know that there could be some potential issues with the model. On the other hand, if the test shows that they're basically statistically significant, then you could now use this model because it has been validated. Again, as you build this model, you also need inputs from the stakeholders to make sure that when you're looking at the data result, that it jives with the real world events and how the consumer, in this case, your end user, expects it. So you want to make sure that the expectations are actually making sense. Okay. Now the last piece of this particular development of the model is basically you have inputs and you also have your outputs. So inputs obviously are the data that you do have, the assumptions sometimes that you need to include into the model. So it could be things like productivity. It could be things like your volume, inventory age, that type of information that goes into the model originally. And then your output logs, you kind of developing certain stages or certain point within the model to measure the entrance and the exit and how long it takes. And it is those measurements that you're going to later test to determine how long it takes to do a particular process and to test whether or not your model is behaving properly. It's using those input data against those output logs. Then, there we go. Then what we actually worked in SB research is all right, so we developed this model. Okay, great. Now we need to use it to determine whether or not this type of method kind of works. And so there were two particular experiments that we ran. One was the post-COVID restart experiment, and the other one was the notice redesign experiment. So the idea behind both of these experiments was, let's suppose that the IRS redesigned the AUR notices, so that would be the CP 2501, CP 2000, and the STEP notice. What would happen if there is an increase in response from taxpayers because the notices were done well or better than they currently are? And so you've had this 10%, 20%, or 30% increase in response. And the idea of the experiment was to test what would happen to the volume of the work that is coming in because of the increase in response. What will be the impact on the age of the inventory, and how this would have in terms of the workload and then the need for employees or no need of employees, or relocation of those employees. On the other one of the post-COVID restarted experiment, as we were finalizing our project, COVID happened. And so AUR works on campus, so people are relatively close to each other. And so the question really becomes, great, we've closed the campus, but eventually individuals have to come back in. Let's run some experiments to kind of determine what's the impact based on different scenarios that the customer thought of as a way to bring back employees given the social distance protocols that we had. And so that was the test that we were trying to assess, is what will be the backlog? How could we clear the backlog? How long would it take? What would be the impact to the workload within the campus? All right. And so then we get into the findings and benefits, and we can easily say that this method is effective in testing operational changes without workload interruptions. So this method could be used to identify different bottlenecks within the system. It can be useful to assess changes into the process, and potentially can be used to optimize resources within a particular process. And then last but not least, you could also use it to identify other notices and determine what will be the impact if you had some sort of redesign. Now, what's important here that these are all great things that it could do, but what discrete event simulation model, it is not cheap. And it is very time intensive, not only to the research organization, but also to the customers organization. So this is something that can be applied, but it should be applied to the areas where you really want to, get a better return on this investment. And so in conclusion, based on the study that we did, we can say that discrete event simulation can be used and can be useful in estimating impact changes in operations, any particular disruption to the operations. Obviously, they have to put in time to help us, and so on and so forth. But in terms of production itself, it's not impacted. With respect to the experiments that we ran, the important thing in terms of its usefulness, the post-COVID experiments showed that running these experiments provided information that was not foreseen by leadership, and they were able to use this unforeseen findings to kind of develop some sort of strategy in terms of how they were going to bring employees back into the campus and how their work was going to be allocated. And so it's definitely useful for stakeholders. And lastly, this method and experiments showed that it could be useful throughout the tax administration community. And basically, it would have a minimal impact on that tax administration itself, because you're not changing the process while you're conducting these pilots or experiments. And with that, I now yield the floor to Chloe. And thank you, everyone.
Hi, good morning. First I want to say thank you to the organizers and the Tax Policy Center. I'm grateful for the opportunity to present and to enjoy others' presentations. And thank you to Mary Helen for the introduction. Again, my name is Chloe Gagan. My pronouns are they, them. I'm an economist in the Statistics of Income division at IRS. I also want to thank my colleagues on this project. I am but one of the analysts on the study. Today, I'm going to share some of the results from our paper, the effects of Forms 1040X and 1120X post-filing adjustments on SOI estimates. Specifically, we're talking about amendments. So historically, SOI research has been based on data that are collected from initial tax return filings, but we know that taxpayers may elect to amend their income tax returns. Common reasons for amending include tax over or under assessment or to correct errors on the original return. We know that amendments can influence net revenue, which in turn impacts fiscal research and policy, all which makes it important to understand the impact of amended returns. Some background on amended returns in general. Taxpayers may amend their initial return after the tax filing period has ended. Under the Internal Revenue Code, taxpayers must file a claim for credit or refund within 3 years from the time the initial tax return was filed or 2 years from the time the tax was paid, whichever is later. But of course, there may be extensions that could allow for even more time to pass. In order to publish statistics in a timely manner, SOI does not wait for the processing of amended return data. Incorporating changes from amended returns would require substantial resources in terms of time and labor, which may not be justifiable depending on the magnitude of the impact. Nevertheless, it is important to understand the differences between the currently published statistics and taxpayers' finalized tax statistics. The study aims to contribute to a better understanding of the difference by measuring the impact of including amended returns to a subset of SOI products. The study is going to focus on amendments made to individual and corporate returns via the forms 1040X and 1120X. The base year for the study is SOI year 2013. This means that the study measures changes made in subsequent years to returns that were filed for SOI year 2013. 2013 was chosen because it is a relatively recent year with at least 3 years of post-filing data. There are a number of exemptions to the general rule of 3 years, so this study identified all amendments to 2013 returns at the time the data were pulled. So current publications will provide estimates for the number of amended returns that are processed in a given year. However, those amendments could be associated with initial filings from any prior tax year. Currently, no published statistics reflect the number of amended returns associated with a fixed initial filing year. Tax adjustments were identified in the IRS master file data and linked to tax returns in the individual and corporate SOI samples. The matched data were weighted using the SOI sample weights, and the weighted sample estimates were compared to population data to verify the appropriateness of the weights, since the weights were initially created around a different set of data. These are the individual income tax return results. Looking at Table 1, these are the aggregate recommended tax change amounts. Note that the money amounts are reported in billions of dollars or millions of dollars, but I'm going to read them aloud in the billions. Tax increases totaled 2.5 billion and tax decreases totaled 4.6 billion, resulting in a net decrease of 2.1 billion. This ultimately is a decrease in the estimated total amount of reported tax liability from Form 1040 filers by 0.16%. For tax year 2013, taxpayers filed 142.9 million individual income tax returns, of which just 3.2 million or 2.3% were amended. Figure B shows the Form 1040X filing rates by filing status. Looking at these bars, we can see that certain filing statuses were more likely to amend than their initial returns, or more likely to amend their initial returns. Specifically, 4.6% of returns filed by qualifying widows and widowers were amended versus only 1.4% of returns filed by those married filing jointly. Figure H shows the Form 1040X filing rates for married filing jointly filers by adjusted gross income. As an aside, in the analysis by AGI, taxpayers were separated into two groups, married filing jointly and filing non-jointly. As seen in this figure, couples with an AGI of over $200,000 were more likely to file an amended return at around 2.2% of returns in this AGI group. Now we're going to shift and look at the corporate income tax return results. Note that the money amounts are in thousands of dollars, and I'll read them aloud as millions. Tax increases totaled $30.4 million, while tax decreases totaled $118.2 million. Corporate filers reported a net tax overpayment of $87.8 million. Incorporating these adjustments into SOI statistics would decrease the estimated total amount of taxes paid by those filers by $87.8 million, or just 0.03%. 1.6 million corporate tax returns were included in the 2013 SOI study year. 8,200, or 0.52%, were amended after the initial tax return was filed. These are small amounts, relatively. Figure I shows the Form 101120X filing rates by industry. Note these are the SOI assigned industry codes. The industrial sector that had the highest rates of amendment were management of companies and enterprises at 1.7%. Manufacturing also had a high rate at 1.4%. Transportation and warehousing had the lowest rate, less than 0.5%, 0.04%. It's not even shown on this figure. Figure J shows the Form 101120X filing rates by size of total assets. Note that the assets are in millions of dollars. At the left-hand side of the figure, you see corporations with assets between 100,000 and 250,000 that had the lowest amendment rate at 0.5%. The amendment rates rose as assets increased along the x-axis up to the peak. At the middle of the figure here, corporations with reported assets between 25 and 50 million, where the amendment rate was approximately 2%. And then the amendment rate sort of declines after that. To recap, in this preliminary study looking at 2013, some 2.3% of individual income tax returns and 0.52% of corporate income tax returns were amended. These amendments decreased the estimated total tax from individual filers by only 2.1 billion, or 0.16%. And this decreased the estimated total tax from corporate filers by $87.8 million, or 0.03%. Thus, this study's review of individual and corporate tax returns from 2013 suggests that while SOI statistics would be affected by post-filing adjustments, current SOI statistics would not significantly change. So thank you for your time. You're welcome to email me with questions or comments, and I'll go ahead and mention that this article has been published and is available on tax stats at irs.gov/statistics.
Let me just make sure. Hello, everybody. Thank you. Thank you, Chloe. I'm going to provide some comments on these three papers. And the first thing I'd like to say is this is a great selection of papers that sort of highlight the importance of administration. It's not always just the policy or the tax code. It's also about how we administer that policy. And I think these three papers sort of cover a little variety of those issues. The first one talking about the potential effect on economy from administration. The second paper sort of talks about how to improve that administration. And the third paper sort of points out the challenges that administering the tax code can have on available data. So the first paper I'm going to talk about was the first one in our that was presented, and this is on the sales tax administration and the real economy. And this first slide, I'm going to talk about sort of, I loosely term potential correlations, but it's really more of omitted variable and causality issues. My first worry is that that the hotel industry size is causality is switched with the choice to administer taxes locally. So the authors suggest that local authorities might administer taxes because they can get revenue quicker and easier, and that could reduce the hotel size, the hotel industry size. However, it's also possible that just having a lower hotel industry or a smaller hotel industry makes it easier to administer taxes locally. So I wonder if we've got some causality flippage there. The second one that I'm a little concerned about, and I think this actually popped up in some of the Q&A, is that you aren't controlling for the transient renting venues like the Airbnbs. And the authors note quite appropriately that this is perhaps the very reason why the local authority would want to take control of that so they can get at these smaller renting venues and these Airbnbs. However, by having a larger transient renting venue, you might actually have a smaller hotel industry. So you could be having a situation where the very ones that are choosing to administer also have larger transient renting venues and already have a lower hotel industry. And this is an increasing trend, so it might even be a growing importance. Having pointed that out, I will still say, though, that given that some of the counties that are doing the local administration are quite large, like Miami-Dade, maybe this isn't as big a problem, but it's certainly something that occurred to me. Now, Roger didn't mention this in his presentation, but it is in their paper, and they use this sort of adjacent county controls as a control for regional hotel industry trends. And I do have a little question of how effective that is. My first thought was that, and I actually went on Google Maps to look, was that Miami-Dade County, right, which also includes the Keys, is bordered by the above county, I think it's Broward, which has Fort Lauderdale, but then its next door neighbor is the Everglades. There's no hotels in the Everglades. So I'm concerned about whether this is going to be an effective way to deal with hotel industry trades. And they mentioned also this issue of, like a new tourist attraction or hurricanes. And one of the things that occurred with me on a hurricane is a hurricane can just wipe out the Keys. So that's only one county and it hasn't affected any other county. And a tourist attraction can, just the announcement can affect things. So I wonder if that's more of a time issue rather than a close county issue. I don't, as always, a lot of times it's easy to critique, but I don't have any suggestions, but just some thoughts. And the last thing I'd like to suggest is an alternate conclusion. The authors concluded that the negative effect of a local administrative taxes on payroll employees, and they had a weak effect on size, indicate that the cost from having local administration, and I suspect those are certainly true, could affect the hotel industry as a whole. But it's also possible that the hotels just changed how they were working, so that instead of having in-house tax administration where they had payroll and employees submitting the forms, doing all that, they just went to contracting with an accounting firm. And that would be perfectly consistent with their current findings, that you had a reduction in payroll and a reduction in employees, but not a significant reduction in the size of the industry. So I just wonder if there's a way that maybe they can try and control for, expenses or something like that. I'm not sure how detailed their data is, but it is something that made me wonder. I think, this is also something I usually I've spent many years specializing in corporate tax and tax incidents. And this was one thing that I always found that was hard, is trying to find a needle in a haystack. And that can be pretty challenging. But I will commend the authors on trying to use the data that's available out there, and especially any switches. We're always, searching for, real-time changes to be able to use to capture things. So I commend the authors on their work. So the second paper was looking at discrete event simulations. Again, great idea. This is awesome. I'm always, glad to see IRS trying to find ways to, use their resources better, deploy them better, and all of that. I just had a couple quibbles and a couple of questions. As usual, is there any reason to think that using one campus to validate the model matters? Is there any reason to think that something's going to be unique to Philadelphia that would be different in other campuses? Of course, I think going forward, you can obviously test and retest in other campuses. The other one, and this is something where I'm not sure myself whether this matters or not, and maybe I'm just overthinking, but I did wonder whether the COVID-19 was just too big of a disaster piece to get at some of the finer tuned aspects of a model. I mean, maybe not, maybe it's good to have both, but it was just something that occurred to me, if that would affect the testing of the model. And then the other couple of things I had were just some questions, which was, I know that you've got mail volume, taxpayer response rates, and a lot of those internal factors. And I was wondering whether you had considered looking into outside factors. My first thought was when COVID-19 happened, we had these real problems with mail and mail not getting distributed easily and real slowdowns. And I wonder if there's a way to incorporate some of these outside factors into the model in anticipation of, if something's coming down or you're hearing in the news that the USPS is just not doing its job, whether you can incorporate that into how to deal with the fact that you might not get taxpayer responses quickly because they're submitted, they're just not flowing in. And then Raphael kind of mentioned this in his presentation, but I thought it was, when I read the paper, it wasn't quite as clear to me, but I'll still mention it again, was that when they talked about the notice to redesign, there was sort of an implicit assumption that that redesign would increase response rates. So I wonder if, from going from the tangible change that IRS is anticipating and the assumption on how it's going to affect taxpayer responses, how important that is. Obviously, it's very important if you're going to assume that it increased taxpayer response rates. But I wonder if there's a way to incorporate those different assumptions. And it wasn't perfectly clear to me how easy that was, or whether there were triggers or levers that you could pull to change that. But overall, I would encourage these kinds of models. I mean, it's great work. And then lastly, the effects on the post-filing adjustments on statistics of income. Again, another piece of great work, because we're always worried about whether the data that is available captures everything. My first couple of concerns were about just using 2014 amended returns. Chloe, I know y'all mentioned that there's up to 3 years of filing, and I wonder how restrictive is it that only having that first year or that first calendar year captures everybody. I imagine that, I doubt another 2 years would probably blow up your results, but it was something that occurred to me. The other thing was, and this one was a little more important in my mind, was the concern that only looking at the following calendar year. So I can imagine that, I don't realize that my 2013 return is problematic until I do my 2014 return. And then having done my 2014 return, I realized, shoot, I really messed up that one aspect in my 2013 return, and so I go to amend it. Well, by that time, my amended return is going to be a calendar year 2015 return, not a 2014 return. And so I wonder if that second year, you might get more amended returns than previously. And then this is more just for display or future work, you talked a lot about the differences in the likelihood of filing an amended return and the different categories, but there wasn't any sort of confidence intervals or any discussion of statistical difference. So especially when you're talking about a 5 versus a 3, my first thought is, well, is that really different or not? And that was just sort of a discussion point. And then what I would like to see going forward was, I love the demographic information, but I'd also be interested in what's the key return items that most affected statistics, even though you found not a big effect. And what were the most common amendments, right? I want to know, what are the things that people are messing up? I doubt it's wages, because those are matched, but is it capital gains, things like that. And that's just as a data lover. We just want more, right? But really, these were some great papers. I really enjoyed it. And I thank you so much for the opportunity to provide some comments. And I will give it back over to Mary Helen. Thank you.
Thank you, Jennifer. So this is the time for the Q&A session. So I encourage everyone to enter questions in the Q&A feature at the bottom of the Zoom. And so we'll start out first by giving the presenters an opportunity to respond to the discussant Jennifer's comments. And so why don't we go in order of the presentations? So Roger, why don't you go first? Thank you.
Certainly. Thanks, Mary Helen. And thank you to Jennifer. I think, this is a new paper, and I think your comments are going to help us out a lot. Some of that reverse causality stuff, is the smaller hotel industry leading to, easier to administer taxes. And maybe that's something we're going to have to think about. I think your outsourcing comment at the end was really interesting and not something we considered at all, right? Is this just hotels cutting down on their workforce because they're in a more complicated compliance environment and they need to maybe bring in some expertise from the outside. That's something we will definitely have to look at and think about. But I thought that was great. And I think you made a comment about Airbnbs, and I think Ron made a similar comment in the Q&A. And it's something we should definitely add in the paper. Airbnb, really started their exponential growth in like 2011, 2012. And one thing we do is confirm that our results hold in that pre-period, right? We still have, 22, 23 years of pre-Airbnb data in our sample. So that's helpful. So we're not too worried about that. But these other points were great, and thank you so much. I sincerely appreciate it.
Thanks. So Raphael?
Hey, thank you. Again, thank you for your comments, and these are very insightful. One of the questions one of the comments you kind of touched upon was that COVID was too big, which is a great question. It was something that we did discuss, and eventually we kind of thought that this type of events may be too big, but they happen often enough. And the way you might want to think of it is almost like the furlough or the shutdowns. While they have a major impact, it's not something that is so rare that it never shows up. And so we thought that it would be useful, and it could be implemented on different scenarios. Again, not just COVID, but it could also be used for something like a shutdown or a furlough for the service. With respect with the limitation, Philadelphia, I'm not sure is unique enough. There are some minor tweaks between campuses, but the main idea was the broader, our focus was in terms of AUR process versus AUR process Philadelphia. The more complex the model will be, the longer it will take, and the longer will be for us to identify whether this type of method was efficient or useful for the operations. So that's one of the reasons why we can focus on one campus instead of the full process. With respect to including outside factors, that could be tweaked in terms of the assumptions. So, for example, if we change the mailing, so we could expect that taxpayers will respond, let's say, in 30 days, and now we hear the news and it says that the Postal Services is delaying some of their services. We could now change those assumptions that instead of 30 days, it's going to take 45 days or 90 days or whatever it may be, and then we could determine what's the impact on the operations in terms of the age of the inventory, what happens to our work case, and so on and so forth. So those are things that you could add to the model, and in some of them they're already in the model, like mailing, for example. But in terms of other, like if we can predict a recession, what will be the impact of that? That I'm not sure would be something we thought of in terms of AUR. Now, in terms of increasing taxpayer response, can they be changed? So some of this was a question that we were trying to answer based on a RAS research project that was trying to determine what type of tweaks they could do to those AUR forms and what would happen to the casework in terms of the AUR operations to get ready for those changes with the CP 2000, CP 2501. And so that's kind of the way, this is kind of the reason why we focus on those particular notices, because we knew that there were some additional research that was occurring at a different research unit. And so that's why we were trying to see, hey, if we run this experiments, maybe we could help you get a head start on what you need or what you may do what changes you may have to do.
Thank you, Raphael. Chloe?
Hi, sorry, I just ran off for a second because my vacuum started. Thank you so much, Jennifer, for all of your comments. I really appreciate, especially the comment you made about statistical significance, and we would really like to know all of the reasons why people amend. Unfortunately, the data we were working with were super granular, and we either had to go into too much detail or not enough detail to really answer those questions. And I think if we had more resources, that would have been the question worth answering. The other comment with respect to what data we used for our analysis, we actually took more than 3 years of data. We pulled all our data and it was more than 3 years past, and we kind of went back and forth on whether or not to pick 3 years or the 5 years that had passed that we had data for, and we decided ultimately to go with the longer period because it would include all of the extensions that people got. So we actually ended up getting a lot of data in, which was great, because when we broke down how many amendments happened, most of them did happen in the first year, like a huge chunk were in the first year, but you could see that more were trickling in over the next couple of years.
Okay, thank you very much. So I encourage anyone who has questions to please enter them in the Q&A at the bottom of the Zoom screen. So right now I'll start going through the questions that we got. The first two were for Roger. So Roger, I'm going to take the second one first. We've already really talked about this a little, but I want to read the question so everyone else can know it's there. And then if you have something more to add. So the question was, for your independent variable, hotel employees, et cetera, does not include the sharing economy, Airbnb. How has the shift toward the Airbnb market affected your results? And is there anything else that you maybe wanted to add to what you've already discussed?
Thanks, Mary Helen. Maybe not a whole lot to add, right? Again, we showed that our results hold in the pre-Airbnb period, which is, again, like 2/3 of our sample period. But I agree that this is fascinating, right? I've got another paper using similar data from Florida where we're looking at, Airbnb and tax compliance and what goes on there. There's some ACS data from the census that some people are using to look at, say, how many houses in a particular county are held out for seasonal or recreational use, which is going to include Airbnbs. And so we've looked at that data, but unfortunately for small counties, which is most of Florida, those estimates only come up every 5 years. So we don't have super granular data on that. But I agree, I'm talking to at least a few dozen federal employees. Y'all have better data than we do. So if there's something going on there, I would read it, but I don't know if I could write that paper.
Thanks. So the other question, the individual writes that they've recently seen proposals to impose progressive sales taxes. How could this work on the ground? For example, how could a car dealer know to charge a lawyer more than a cook?
Yeah, so I thought this was an interesting question. I hadn't actually read much about progressive sales taxes at all. So I appreciate Carl for throwing that out. I think the takeaway from our paper, at least the takeaway that I have, is that it doesn't matter how good the plan is or what the social intent is of these different taxes. We can have a lot of goodwill behind these policies, but on the ground, somebody's got to administer it, right? And I think our paper shows that if you make hoteliers also become, tax experts 1 or 2 days a month, it imposes deadweight costs on the hotel industry, right? So I would expect something really similar, right? If we expect car dealers to become, tax experts 1 or 2 days a month, I expect we would see some slowdowns in the automobile industry. So, I think my takeaway here is, despite the really pro-social ends behind a lot of these tax policies that we could plug in for this progressive social tax, if you make it more difficult for taxpayers to calculate and pay their taxes, you're going to see some deadweight losses in the economy.
Thank you. So the next question is for Chloe. So the question is, how will the ability to electronically file an amended individual income tax return, a Form 1040X, affect the IRS's ability to incorporate amended returns data into SOI?
That's a great question. So the majority of corporate income tax returns that are amended, the majority of those amendments, if the original return was electronically filed, the amendment has to be electronically filed. So we already have e-file data for the corporations. I'm not sure if that really affects so much our ability to impact it as does the time period that passes. Corporations might be able to apply for an extension that allows them an extra 7 years. And for instance, there's lots of examples of major environmental disasters in which there's been an extended period of time added, especially with COVID this last year. There was a filing extension for everyone, or for individuals rather. And we see these like year-to-year changes just being so erratic that incorporating amended returns at all would be a really hairy process to try to say when and where you want to set those cutoffs, because it does change so much year to year, even if they are electronically filed.
Thank you. So the next question is also for you, Chloe. It says, will the recent IRS adjustments to 2020 Form 1040 returns, the individual income tax returns for the unemployment exclusion and excess premium tax credit changes be incorporated into the IRS SOI data? I think this is sort of related to amended returns, because IRS has set up processes so that individuals do not have to file amended returns.
Right. Yeah, exactly. Yeah, those credits were issued without an amendment this past year. I can't speak too much to the individual side because I'm actually I'm on the corporate branch, but I don't know to answer that question.
Okay, thanks. So I have a few questions, and that will give time for others. If you have questions that you want to add to the chat, please go ahead. So I guess, Roger, I'll start with you. I have a question for each of the presenters. So I also had a question about the Airbnb, which we've talked about already, but I also had another question about whether you had information on sort of the processes of filing the local returns, and whether sort of the process differed dramatically across counties, and whether some were easier, like maybe some counties had online accounts and it was really simple to file and others didn't, and whether you had any information about that, whether you had that kind of information to potentially include in your analysis.
Yeah, and that's a great question, Mary Helen. And there's definitely variation, and your intuition is perfect in that some of these counties, allow for online payment. Some of them you're required to mail it in. But there's even more, I think, fine-grained differences, right, in this just compliance complexity, because for some of these counties, it's tough. You can't go online and figure out when the deadlines are. You can't go online and figure out what the forms are supposed to look like. A lot of this, you've got to walk into the county administration office and pick up forms and that kind of thing. So there is definitely some cross-sectional variation there. We don't control for that at all, right? It'd be tough data to get. And even within counties, right, there's a lot of time series variation. So, I expect when, Miami-Dade County, took over home rule of this local hotel tax in, the early 90s or late 80s, whenever. I expect that was paper-based, right? And then, they transitioned at some point. So I think it would be really interesting to look at that. We don't have that data for Florida. If anybody else out there is listening and is interested, I think that data is available for Alabama's 805 different sales tax jurisdictions. I've in kind of doing a little research and seeing what data is out there. The Alabama Department of Revenue has been surprisingly rich in data. So if you're looking for your next paper, listeners, that's maybe something. But no, we don't have that data in our setting. But yeah, it would be super cool if somebody has a connection to the 67 different local tax administration offices in Florida. We would be very excited to hear.
Thank you. So my next question for Raphael. So I was wondering if you could talk a little bit more about what the plans are for using the simulation model in the future. Have there been any decisions made about how it might be used?
So once we were finalizing the idea of the actual discrete event simulation model in terms of using it for different type of simulations, we began working on ACS, and we kind of started the work last year. And
so let me interrupt. ACS. So ACS is automated collection system, right?
Yeah. And so we are basically doing the same idea with ACS. We're starting it in one campus, seeing whether or not it works, how well it works, and then potentially expanding it further. Again, as you can see, we're trying to work through the rather larger operations or work units that could yield some good information if those if those discrete event models are implemented. Because again, they can be interchangeable between one campus and another one, as the prior discussions was made. But it's very hard and time consuming to develop the actual model. So you want to make sure that you could, once you build one for a particular operation, it could be used throughout other different campuses within that operation.
Thank you. And Chloe, I have a question for you. So I realize that your paper is focused on trying to ascertain what the effect of amended returns is on the SOI weighted statistics. I work in the compliance area and a lot of focus on reporting accuracy. So I was wondering if during the course of your analysis, you looked at amended return filings by whether there were more or fewer by paper or e-file, and also whether you looked at sort of the amended return filing based on the distribution of when the original return was filed, whether it was filed sort of early in the regular filing season, or if it was filed sort of on an extension, and whether you had any information on that. I realize that wasn't actually your focus, and those are more sort of my points about, are people more likely to file amended returns? And if they file early in the filing season, maybe they don't have everything and they didn't realize it. Thanks.
Thank you for those questions. Those are really great. One of the things that we thought about was when people would file an amendment, and maybe if they were due a refund, they would file sooner. And that was sort of our theory looking into that. We did kind of get a rough breakdown of that information, but it was it didn't end up in the final paper. But what did end up in the paper was the discussion about e-filed versus paper returns for the corporate filers. That information is out there. I don't have the exact numbers off the top of my head, but we did include that breakdown.
Thank you. Unless somebody submits a question to the Q&A right away, I would like to thank all our presenters for session 2 for a great session. We'll now be having a break. We will return at 12:40 for our keynote speaker, Mark Mazur. Thank you, everybody.